Alrighty. So welcome to the only wheel strategy course you'll ever need, where you get to master the wheel strategy in the next 2.5 hours, even if you're a beginner. So what I've done for this video is that I've compiled the very best wheel strategy trainings that I've created, and then I've organized it, structured it in a very sequential manner where you get to literally learn everything you need to know about the wheel strategy in just one video. Right? So if you ever thought of, buying a wheel strategy course, well, guess what? There's no need for you to do that because you get to learn everything you need to know in this one video. And I even share with you how I personally trade this wheel strategy, right? So there's no need for you to spend money to buy a course because you can get it all for free in this video. So let me just very quickly share with you what you exactly learn inside this wheel strategy trading course. So I've broken them down into a few chapters. So chapter number 1, you first get to understand how the wheel strategy works, right? What it is and how do you get started with it. Chapter 2, I'll also share with you a variation of the wheel strategy, which is what I call the enhanced wheel strategy. Then chapter 3, this is where we get into the risks of the wheel strategy, right? Too many times people get into the wheel strategy without understanding the true nature of the risks of the wheel strategy, and then they get into trouble, right? So this is where you really need to understand the risks. And then chapter 4, this is where I go a little bit deeper. I don't just tell you the risks, I tell you how to make the wheel strategy safer for you to trade. Now, next chapter 5, we're going to be talking about how you can generate triple income from the wheel strategy. And chapter 6, I'm going to give you a simple entry and exit plan that you can follow along. Now, chapter 7, this is where we get into the wheel strategy stock selection guide. And this really is the important part that you have to take note when you're trading the wheel strategy, because too many times people get into trouble from the wheel strategy. Usually it's because of the wrong stock selection. So inside this chapter, I share with you exactly what you need to look out for when you're selecting stocks for the wheel strategy. Now, chapter 8, this is where we get into the income grid wheel strategy. So this is how I personally trade the wheel strategy. Then chapter 9, we get into the income grid wheel strategy trade example, where I show you exactly how I implement the income grid wheel strategy. So these are actual live trades. So chapter 10 is part 2 of the trade example. And finally, chapter 11, this is where I get into the wheel strategy for small accounts. All right, so if you're ready, let's dive right in. Okay, so here's how the options wheel strategy work. So we always start off by selling a put option with the intention to buy 100 shares. So this is what is called a cash secured put. Now, I've created an extensive video all about this. So if you want to go and watch it, just go ahead to my channel and you can see the videos on cash secured put. But basically, when you sell a put option, you have the obligation to buy 100 shares of the underlying stock if you get exercised. So for example, if we sold a put option at the strike price of, let's say, $50, and if the stock closes below $50 at expiration date, then you have the obligation to buy 100 shares at this $50 price. Alright, so once you are already long these 100 shares, the next step is to then sell a call option to sell away those shares. Now, this is what is called a covered call. And again, I have many videos on a covered call. You can just go ahead to find them and watch them. But basically, when you sell a call option, you now have the obligation to sell 100 shares of the underlying stock if the option gets exercised. So for example, we now have sold a covered call at $50. So if the stock was to go above $50 and it closes there at expiration, then now you have the obligation to sell away the 100 shares at $50. So that is how the wheel strategy works. So I'm going to give you a few steps. So step 1, we always start off by selling a cash secured put. All right. By selling a cash secured put, we will receive a premium. And then the next step is to see whether we get assigned on the cash secured put, right? If we are assigned, we get the 100 shares. But if we are not assigned and it expires worthless, we just simply go back to step 1 and then sell another cash secured put. And we keep selling the cash secured put until we finally get assigned on that put, all right? So once we have been assigned the 100 shares, the next step is to sell the covered call. Right, so once you sell the covered call, again, we just have to wait to see whether the covered call gets assigned and our shares get called away. If our covered call does not get assigned, all we have to do is just keep selling another covered call, and we keep doing this until the shares get called away. That means our call options get exercised. So as you can see, this is why it's called the wheel strategy, because we are just doing the same things over and over again to generate income, right, over time. So I want to give you a visual illustration so you can see exactly how it works. So let's say, for example, we want to sell a cash secure put at $112. So this is the strike price that we want to sell at. So when we sell this cash secure put, let's say we receive $2.50 for it, right? In premium, this is $250 into our account. Now the next step is simply to wait to see where it expires, right? Does it expire worthless, or do we get a sign on it? So let's say the market comes down below our cash secure put strike price, and then at this point in time we are now assigned. So if we are assigned, we are long 100 shares at $112. So what is the next step? It is to sell a covered call. So we sell the covered call at the price where we long 100 shares at. So again, by selling this cover call, we receive another premium. So let's say we receive $2.50 for this. So it is $250. So at this point in time, we already collected $500. And all we have done is just buy the shares at $112. The stock hasn't even moved in our direction yet, and we are already collecting $500 for that. So the next step is just to simply wait to see if the stock goes up to get our shares assigned, have it called away, or if it expires worthless, then we sell another covered call. So let's say on this date, the option expires and the stock is above our strike price. So at this point, our covered call is assigned and our shares are called away. So at this point of time, we no longer have the 100 shares. So we no longer have a position. So what we have to do is simply sell another cash secured put. So again, we sell the cash secured put, and let's say again we receive $2.50 for it. So by this time, we have now collected 3 of this $2.50. So that is a total of $750. So then we wait and see whether we get assigned. So in this case, the market did come down, right? And then we have been assigned another 100 shares, right? So now we are long 100 shares again at $112. So now that we are long 100 shares, what do we do next, right? You know the drill. We just simply sell another covered call, and again we sell at the same strike price, and we collect $2.50. So we have now collected $1,000 in premium just by selling the cash secure put and the covered call. So let's say on this date, the stock finally is above $112 and our covered call expires. This is our expiration date. So we are now assigned, and our covered call, our shares have now been called away. Right, so at this point in time, again, we have no more positions, so we just rinse and repeat. So we sell the cash secure put again to initiate the wheel all over again. So as you can see, this is really like an income generating machine. You're just selling this cash secure put and this covered call to keep collecting this premium. Now for the enhanced wheel strategy, instead of selling the cash secure put, we will instead be selling the put ratio spread. Now, if you don't know what a put ratio spread is, please go and watch the other videos which I've already created on this on my channel. But a very quick recap, a put ratio spread is basically where you buy one put option, all right, and then you sell 2 further out of the money put options. All right, now this can be 2, can be 3, can be 4, any number. For our purposes, we want to use the traditional 1:2 ratio spread. So basically what this is an embedded long put spread, and you have one additional short put, which is your cash secure put. All right, so in this case, you have an additional long put spread on top of your cash secure put, which becomes the put ratio spread. So in essence, you're using the premium which you receive from your cash secure put to go and finance the purchase of a long put spread, which is in this case what you call a bear put spread. So ideally for this, what we want is for the market to go down. So this way you will make the maximum profit on this embedded long put spread. All right, so same thing, if the market is to go below the additional short put strike, the additional short put option, At expiration, you're going to be assigned 100 shares. So once you've got these 100 shares, instead of selling the covered call, what you will be doing is selling a covered call ratio spread. So again, I've already created a video on this. I call this the enhanced covered call strategy. If you haven't watched that, I put a link at the top right hand corner of this video. Go ahead and click there and watch that first. But very quickly, what a covered call ratio spread is simply just the opposite of a put ratio spread, right? So instead of using put options, you use call option. So you start off by, right, you have a one call option, you long one call option, and then you sell two call options that's further out of the money. So again, you have this embedded long call spread. So in this case, you want the market to go up. So same thing, we use the cover call, right? The one short call option which we sold, the premium, we use that to finance the long call spread. So in this case, it's called the bull call spread. So if the market expires, or rather is above the additional short strike, the additional short call strike expiration, this is where your shares will get called away. Again, your position is back to zero, and then you start selling the put ratio spread again. So you do this over and over again. So this is the enhanced wheel strategy. So all it basically is to change the cash secured put to a put ratio spread and change the covered call to a covered call ratio spread. Okay, so what is the difference between these two? Well, let's have a comparison. All right, so let's simulate a traditional wheel versus the enhanced wheel strategy. All right, we're going to put them side by side and see which one does better. Okay, so this is the chart of Starbucks. So let's say, for example, you want to own Starbucks. Let's say that you think that Starbucks is a good stock. You want to buy it at, let's say, $77.50. All right, so we have decided that $77.50 is a good price for us to enter. Okay, so let's compare both of them. So for the traditional wheel strategy, what we're doing is we are going to sell a cash secured put. So in this case, since we've identified that $77.50 is where we do not mind getting assigned 100 shares, so this is where you want to sell the cash secured put. So for the cash secured put, you can see we received a premium of $1.98. So there's $198 per contract. For the put ratio spread, for this put ratio spread, as you can see, we sold the long put option at $82.50, and then we sold two put options further out of the money at $77.50. So this too is the same price. So what's the difference down here is that there is this embedded long put spread, right? That is 5 points wide. That means if the market, right, let's say it goes all the way below here at expiration, you'll be able to receive the full profit of $5 on this embedded long put spread. So for this put ratio spread, you receive a much lesser credit because you have used the premium that you receive from selling the cash secured put to finance this long put spread. So your credit which you receive will be only 24 cents, so that is $24. All right, so let's take a look at different scenarios to see how they perform. So for scenario number one, let's say Starbucks is above $82.50 at expiration. So for the traditional wheel, what's going to happen is that the cash secured put is going to expire worthless, and your profit is simply the credit which you receive for selling the put option, so which is $198. Alright, so let's take a look at the enhanced wheel strategy. So for the enhanced wheel strategy, this whole put ratio spread is going to expire worthless as well. So if it expires worthless, the only profit you're going to have is just the credit which you receive for selling the put ratio spread, which is only $24. So as you can see, in this case, if the market doesn't even go below the long put option of your put ratio spread, then the cash secured put is going to make much more money, right? So in this case, right, in hindsight, if the market is going to go up, then your cash secured put is going to do better. Okay, let's take a look at the next scenario. So scenario number two is if Starbucks is in between $82.50 and $77.50. So basically the price has entered into your long put spread, which is essentially what you want for the put ratio spread. So let's see what happens. So for the traditional wheel, the cash secured put expires worthless as well, and again your profit is the same, right? As long as the price settles above your short put strike for the cash secured put, then the profit you're going to receive is going to be the same regardless, right? Whether it goes very close to it or far away from it, you're just going to receive the credit at which when you first sold it. So that is $198. So what about for the enhanced wheel strategy? So for the enhanced wheel strategy, the profit is going to be very dependent on where the the price settles at expiration. So in this case, let's say the price settles at $80.25 at expiration. So that is somewhere down here. Okay, so let's say the stock settles at $80.25 at expiration. Well, your profit is going to be $199. So how you derive this profit is basically you just take the credit which you receive for selling the put ratio spread, right? Then you add on to the difference between the long put strike and where the stock price settled at for expiration. So in this case, 80.25. So you take $82.50 minus $80.25. So that's around $1.75. $1.75 plus 24 cents, you get $199. So as you can see, the profit is actually about the same, right? It's the same as the cash secured put. So what does this mean? It means that as long as the market settles anywhere from this point to this point, at expiration, the cash secured put would actually do better, right? You would do better with the traditional wheel, because as the stock price, right, let's say it's above $80.25, that means the embedded long put spread on your put ratio spread is not going to make as much. Okay, so the only time where the put ratio spread for the enhanced wheel strategy is going to perform better is if the market goes below this point of $80.25. So anywhere from $80.25 all the way down here, your performance, or rather the profit which you're going to receive, is going to be much higher, as you can see from here. So let's say, for example, if the stock settles at $78.50, which is somewhere here, if it settles here at expiration, the profit is going to be $424 because you have taken $4 out of this 5-point wide spread, right? So from here all the way to here, you have taken $4 on your embedded long put spread. So as you can see, you make much more, double the amount, than if you were to sell the cash secured put on the traditional wheel strategy. Now let's take a look at scenario number 3. So scenario number 3, what if Starbucks is below $77.50 at expiration? So what's going to happen? So first of all, they're both going to be exercised. So for the traditional wheel, you're going to be long 100 shares at $77.50. This is where you sold your cash secured put at. So in this case, we do not really calculate the profit per se, because it's actually not in an overall profit yet, because right now you are just long the 100 shares. So for you to realize any profit, you have to close out of this position first, then you tabulate the profit. So in this case, instead of tabulating the profit, what we want to do is we calculate the break-even price. So the break-even price, you basically just calculate it by, long the price which you are long 100 shares at, and you minus off the credit which you receive, $1.98. So your break-even price is $75.52, which is somewhere around here. So what about for the enhanced wheel strategy where you're using the put ratio spread? So for the put ratio spread, you'll be exercised as well. So you'll be long 100 shares at $77.50. And then we're going to calculate the break even as well. So for the break even, as you can see, it is much lower. It's going to be at $72.26 because you have this embedded spread. The embedded long put spread has already made you $5, right? Because you had an embedded long put spread from $82.50 all the way down to this point, $77.50. This is $5 in profit. So you take this $5 in profit, you minus off the price which you went long 100 shares at, as well as the credit, right? You minus this off as well, you get $72.26. So as you can see, it is so much lower than where you would be if you just sold the cash secured put, right, for the wheel strategy. So in this case, you will be better off with the put ratio spread, right? The enhanced wheel strategy would be better because you have this added protection to the downside. With this added protection to the downside, your break even is lower, which makes it much easier for you to profit on the way up as well. So if the market settles at $75, right, at this point of time, you can either just choose to close out your long shares at 100 shares. You'll still be in profit because your break even is so much lower down here, or you can just simply sell your covered call ratio spread, right, maybe at this point, and then you have the embedded long call spread from this point to this point, right? So anything from here, you make additional again on your embedded debit spread. But whereas for your cash secured put, right now at this point, let's say for example, if it's at $75, right, then you're still going to be at a loss for your 100 shares because your break-even price is above. So in this case, you may want to wait until the market goes a little bit higher before you can sell the covered call, or maybe you can try and sell a covered call right now to see if it gives you enough premium. Okay, so this is for scenario 3. So for scenario 4, basically this is what I've just covered. This is what you're going to do if you're going to sell your covered call and your covered call ratio spread. Now I cannot simulate the order ticket to let you know how much you can receive, because the price is not right now at $77.50. But I've already covered this in another video, which is called the enhanced covered call strategy, to show the comparison between the normal covered call and the enhanced covered call strategy. Alright, I also share with you the pros and cons of both, so go ahead and watch that video. Again, I'll put the link at the top right hand corner of this video so you can go ahead and watch that. Okay, so I want to talk a little bit about the mindset and psychology differences between the traditional wheel strategy and the enhanced wheel strategy, because when you put on the traditional wheel strategy compared to when you put on the enhanced wheel strategy, your psychology is going to be very different. All right, so the strategy mindset for the traditional wheel strategy is that you do not want to get assigned, right? When you sell the cash secured put, we ideally want to only collect the premium on the cash secured put. That's because the premium will be the same regardless if you get assigned or not. So let's say the current price of the stock is here. What we do is we will sell a cash secured put somewhere below the current price. So we will let's say we receive a premium of $2 for this, right? Ideally what we want is to see that the market goes up immediately. This way the cash secured put will lose its value and will be in profit, right? We ideally do not want it to come down and have us assigned. So if the stock actually starts going down, you will see that this cash secured put will start to increase in value, right? If it comes all the way to maybe to this point down here, right, your cash secured put may have increased to $4, which means you're seeing a $2 loss on your cash secured put. So that is why the psychology over here, right, the strategy mindset over here is that we ideally want it to immediately go up the moment we sell the cash secured put. Now this is very different from the enhanced wheel strategy when we are selling the put ratio spread, because with the put ratio spread, we actually are prepared to get assigned. We want it to go down. We want the stock to go below our short put, because that's how we can get the max profit on the bear put spread. If the market doesn't go down, then we're not going to make money on our bear put spread. And you can also make more on the covered call ratio spread than the covered call when assigned. So first of all, let's talk about this. So the put ratio spread, say this is the +1 put option, and then you have a 2 put options down here which you sell, and let's say this is where the current stock price is. Now if the market was to go up, are you going to make more or make less? So as we have seen in the scenario 1, we actually do not make much money at all, right? We're pretty much making scratch to a little bit of money if the market goes up. Ideally what we want is the market to go down, because in this case if the market was to go past our short strikes, then we'll be making the full profit on our embedded long put spread, which is very different from the cash secured put. With the cash secured put, you don't want it to go down. If you sell the cash secured put and it starts going down, you start to feel, a little bit uneasy. But if the market starts going down after selling the put ratio spread, suddenly you start to feel, excited, because that is where you can potentially realize the full profit of your put spread. Now what about for the covered call ratio spread and the covered call? So it's basically just the same but the opposite, right? For the covered call, you just receive a credit by selling the covered call, just the premium, regardless whether the market goes up or down, you're going to receive the same. But for the covered call ratio spread, because you have now a embedded long call spread from here to here, if the market was to go up past our short strike for the covered call, we will actually make much more. Alright, so let me just delete all this drawing. Let's talk about the entry psychology. So the entry psychology, basically when we enter the cash secured put for the traditional wheel strategy, we want the stock to stay above the cash secured put. So as mentioned earlier, once we sell the cash secured put, we don't want to see it come down, right? Ideally, we want the stock price from this point where we initiated the cash secured put, we want it to go up. So if the stock drops after selling the cash secured put, we could have gotten a better premium on the cash secured put. So that is why, as I mentioned earlier, if the market goes down, you could have said to yourself, I wish I could have waited, a bit longer before selling the cash secured put, because in this case, you would have gotten much more premium. But for the put ratio spread, we want it to actually go down to the bear put spread zone. So if the stock drops after selling the put ratio spread, the strategy is working. So you can see there's a difference in psychology here. If the market comes down, you're excited with the put ratio spread. not so excited with the cash secured put, right? But if the market goes up, of course, you're excited with the cash secured put, not so happy with the put ratio spread. But at least you're still making some money. You're not going to go out of the trade empty-handed. Now, what about the exit psychology? So the exit psychology is where you're already long 100 shares and then you want to get out of it with a covered call. So with the traditional wheel strategy, we want the stock to be as close as possible to the assigned price to get higher premium on the covered call. So once you're assigned, let's say for example, this is where you are long now 100 shares. If the current stock price is down here, if you were to sell the covered call at this price, right, you may not get that much of a premium compared to if you waited for the market to go slightly higher and then you sell the covered call, right? But for the covered call ratio spread, it doesn't really matter that much because you can actually adjust the strikes, right? You can adjust where you put the call spread. So for example, again down here, if you're long this 100 shares down here and the current stock price is again down here, what you could do is you can just simply sell the covered call down here. Okay, so you receive a premium for that and then you buy the embedded long call spread. So you can choose to buy an at the money long call spread where the long call option, the +1 of the long call, will be here, and then you see how far of a spread width you can get for this embedded long call spread. So let's say for example, if you receive $2 on the credit for the covered call, you see how far can $2 get you. If it gets you all the way to here, then this is where you will be selling the additional short call option. So that means if the market was to go up just a little bit and then expire at this point in time, you'll be able to make the profit from this point to here. If it goes even further, all the way here, you'll be making even more on the embedded long call spread. And if it goes even further down here, then in the end, you'll be making a pretty big profit on your embedded long call spread compared to if you just sell, your cover call at this point in time. All right, so this is the mindset and psychology difference between the traditional wheel strategy and the enhanced wheel strategy. So to put it simply, the mindset and psychology for the traditional wheel strategy is that you want the market to go up the moment you put on your cash secured put, right? Ideally, you don't want to get a sign. But for the enhanced wheel strategy, you're actually looking forward to get a sign. So you welcome the market to go down. Now, remember, when you are doing this strategy, your risk is on the downside. So that is why you want to get as much downside protection as possible. And the way to do that is with the enhanced wheel strategy because you have the put ratio spread. Alright, next let's get into the pros and cons of the traditional wheel strategy and the enhanced wheel strategy. So the pros for the traditional wheel strategy is that you have consistent premium collection, right? So you just keep on selling the cash secured put, right? Regardless if the market goes up, goes down, get you assigned or not, you're going to receive the same premium. And it's simpler to execute because it's just one option. And then you receive more premium on the cash secured put than the put ratio spread if the stock goes up. And then you have more premium on the covered call than the covered call ratio spread if the stock doesn't go above the embedded long call spread in the covered call ratio spread. Again, I talked about all this in the other video on the enhanced covered call strategy. Now, what about the pros for the enhanced wheel strategy? So for the enhanced wheel strategy, right, you have a bigger max profit potential than the traditional wheel if assigned on both the put ratio spread and the covered call ratio spread. And the reason is because of the embedded debit spread. And because of this spread by itself, you actually have more protection on the downside, right? When you have more protection on the downside, you have a lower break-even price than the traditional wheel as you have seen. And it's easier to exit the long stock position because of the lower break-even price. Now, what about for the cons? Now, for the traditional wheel strategy, you will have lesser profit than the enhanced wheel strategy if it's assigned, right? You're going to have lesser downside protection as well because you have a worse break-even price than the enhanced wheel strategy. And then it is harder to exit the long stock position because of a worse break-even price. Now, what about for the enhanced wheel strategy? The cons is that you have inconsistent profits, right? Because the profits is largely determined by where the market settles at expiration, right? It's not like the traditional wheel strategy where you know upfront how much you're going to make, because every time when you sell the premium for the cash secured put and the cover call, you're already going to know that's the max profit that you're going to make on it. But for the enhanced wheel strategy, it's a little bit hard to calculate. Now, there's also more decisions to make to adjust the put ratio spread, as you have seen, okay? Now, the put ratio spread doesn't make much if the stock keeps going up, as you can see in scenario 1. And the cover call ratio spread doesn't make much if the stock is below the embedded long call spread. So, as you can see, both have its pros and cons. Okay, so let's take a look at some takeaways. So, both the traditional wheel strategy and the enhanced wheel strategies are viable strategies. Alright, the success of both strategies is dependent on the underlying stock. That means if you pick a stock that is not going to go up in the long term, then both strategies are going to lose you money. But if you pick a stock that is going to go up in the long term, then both strategies are going to make money. And there isn't one that is better. It comes down to what the stock does, right? If the stock continually goes up without going below the cash secured put, then the traditional wheel strategy would fare better. And if you get assigned on your cash secured put, then the enhanced wheel strategy would fare better, right? If you want more protection on the downside, then the enhanced wheel strategy would be better. And if you want consistency or premium collected regardless of what the market do, then the traditional wheel strategy would be better. So ultimately, how do you decide which one is better? It comes down to which one you feel more comfortable with psychologically, right? If you feel that you're more afraid of the downside risk, then go with the enhanced wheel strategy. If you do not mind and you just want to maximize the profit regardless where the market goes to, then you can go for the traditional wheel strategy. Now you might be wondering, this options wheel strategy sounds a little too good to be true. Are there any risks? And yes, there are some risks and you want to be aware of it. Now the biggest risk with this options wheel strategy is that you sell the cash secured put, alright, and then you get assigned on it, and then the stock never goes up, never goes back up to the price where you bought the stock at, right? And imagine if the stock just keeps going all the way down. So this is a big risk because by then you will be long 100 shares, which is $13,600, and then the premium which you have received for selling this would not even come close to covering the amount which you have put into the stock. So if it takes forever to finally go back up, then your money is actually stuck in this stock, right? And if it never goes back up, then you are in a loss. So how do you mitigate this risk? How do you make this option wheel strategy a little bit safer? So I'm going to share with you a few tips on how you can make the options wheel strategy safer. So the first tip is to ensure that you have enough funds to get assigned 100 shares. Right? So if the stock is $30, then 100 shares would mean that you need $3,000 to fulfill this purchase of the 100 stock. Now there are some people who maybe only have $1,500 in their trading account, and then they still go ahead to do the wheels option strategy on a stock that is $30. So what happens is that they are trying to utilize margin. That means they trade on margin. You can't do that, but what happens is that when you're on margin, what actually is happening is that you are borrowing the other 50%, the other $1,500 from the broker. And when the broker lends you this money, they actually charge you an interest rate. So as you can see, this is the interest rate depending on your account size. So if your account size is under $10,000, you'll be charged a pretty hefty 11% on the borrowed money. So if the stock takes a very long time to finally recover back to the price which you bought it at, then this 11% can really amount to quite a bit, because this interest down here is accrued on a daily basis. So you're actually being charged a financing charge, a margin charge every single day that you're holding on to the stock. So if the stock takes, let's say, years to finally go back up to your strike price, to the price which you bought at, then you'll be charged quite a lot of money by the broker, right? And then your premium which you receive may not even be enough to cover this margin charge. So as always, for myself, I always prefer to have the full cash to be assigned the 100 shares. So if the 100 shares is going to cost $3,000, I'm going to ensure that I have $3,000 before I go ahead to do the options wheel strategy. Now the next tip is to wait till the stock is oversold before selling the cash secured put. So what do I mean? So overbought or oversold is basically an indication by indicators. So there are indicators, like this is the stochastics oscillator. So what it does is that it tracks whether the stock is overbought or oversold. So you can see that there's this blue squiggly line down here, as well as two purple lines. So if the blue line was to go above this purple line, it would indicate that the market is overbought, and if it goes below this line, it will indicate that it's oversold. Now what we want to ideally do is sell the cash secured put only when the market is oversold. So this way we know that if the market is oversold, there's a higher chance for the market to rebound back up soon after, right? So as you can see, there are a number of instances where the indicator stochastic says that it is oversold, and then the market subsequently goes back up. You can see this is oversold, market goes back up, and at a time when it's oversold again, market goes back up, and at times oversold, and the market goes back up, right? Now one thing to understand is that this is not 100% working all the time, right? It's not like every time the indicator is showing an oversold, right, indication, that the market will always bounce back up. The thing is that there's a higher probability that it will bounce back up than it will go back down. So it's much better to sell a cash secured put when it's oversold than if, let's say, the market is overbought, right? So if the market is overbought, it means that there's a higher chance the market will subsequently go back down rather than go back up. So if you're selling a cash secured put, and let's say you're going to get a sign on the shares, you want ideally the market to go up after that, right? And the better way for you to do that is when the market is oversold rather than when it's overbought. So we want to be more strategic and smarter when we are trying to sell our cash secured put. The next tip is to sell the cash secured put below a support area. Now, if you're not familiar what a support area is or support level is, it basically just is a place on the chart where, you know, the market has difficulty going below. So as you can see, this is the previous low. So if you were to just draw a line down here, right, you can see that the market has trouble trying to go below this, right? It tried to break below this low, but then it couldn't, and then it subsequently goes back up. So these are places that you want to look out for on the chart as well to see where it could be a good level to sell the cash secured put, right? To initiate the options wheel strategy. So here's another place, right? You can see that this is a resistance. You can see the price had difficulty trying to break up, trying to break out of this area, and finally it broke out. And then this resistance area sort of became a support area. You can see that the price went up and then it started to bounce off this quite a number of times. So this can be a good area to say that, hey, you know, there's some support here. I want to sell my cash secured put below this area. So we can see on the right hand chart, this is slightly oversold. It's going to the oversold territory. So what we can do is that we can identify this as a support area, and then we could sell a cash secured put below this area. Maybe you can sell at 163, maybe even lower 160, depending on how much premium which you can get. So as you can see, this is much smarter than if you were to just sell a cash secured put anywhere you want. Now the next tip is to avoid choosing stocks just for the high premiums and to choose only fundamentally good stocks. So there are a lot of stocks out there that gives very high premiums because they have very high implied volatility, and there are a lot of traders that are trading this sort of stocks because if they give you a juicy premium, then it means that you can make much more on your covered calls and as well as your cash secured put. Now the problem with this kind of stocks is that they may not necessarily be a fundamentally good stock. That means that it could be high volatility, gives you high premium, but the stock could not go up in the long term, right? So for example, if you take a look at these two companies, right, this is the income statement for company, okay, let's say this is company A, this is company B. So if you were to take a look at company A, the revenue is the blue bars. You can see that it's pretty inconsistent. Certain years is, you know, high, certain years is low. Basically, it's not increasing at a very nice rate which we want. And you can see that the bar in yellow indicates that it's not making money at all, right? The net income is negative for the past 5 years. It's not making money. Whereas on this side of this company, company B, you can see that the revenue is increasing over time and the net income is positive as well. has been increasing over the past 5 years. So if you were to do the options wheel strategy, would you rather do on company A or would you rather do on company B, right? You definitely want to do on company B, because if a company is making money and is continually making money over the number of years, then you will know that it has a good chance of the stock always going up in the long term. So what is these two companies? As you can see, company A is GameStop and company B is Google, right? So you see a lot of traders, they are actually trading GameStop because it's giving a very high premium. Now you can definitely trade that, but if you want to do the options wheel strategy, you ultimately want to go do it on a stock where the market will go up in the long term, because if it doesn't go up and your cash secure put, or the place where you buy the stock at, the stock doesn't go back to that point, then you will not be making any money on the options wheel strategy, right? So it will be safer to do on fundamentally good stocks. Now the next tip will be to choose broad-based index ETFs, right? Like the IWM, which is the Russell 2000. You have the triple Qs, Spiders, EMXLF, and etc., right? So the thing with individual stocks is that it can easily be affected by many things that happen, right? Let's say, for example, if the stock changes its CEO or something happening with the company that changed the business direction, the stock can really be affected. It can crash, right? But whereas for an ETF, it holds a basket of stocks. So when it has a basket of stocks, the chances of it actually going to zero is lesser. For example, back in 2008, there was these two stocks, Bear Stearns as well as Lehman Brothers, right? They went bankrupt during the 2008 financial crisis, right? And if you had did the options wheel strategy on both of them, then sad to say that you would have lost all your money. But if you do the broad-based index, like all of these ETFs, even though that during the 2008 financial crisis, the market did go down, but the ETFs eventually did recover, right? So if you did the options wheel strategy on them, you would eventually make money, right? So for example, this is the ETF, the XLF ETF. It tracks all the financial stocks in the market. So back then, 2008, Bear Stearns and Lehman Brothers, if I'm not wrong, they were also included in this ETF. They were part of this ETF. So while it did crash, right, it ultimately did go back up again. Whereas for Bear Stearns and Lehman Brothers, they went to zero. So if you want it to be safer, you want to trade the options wheel strategy in a safer way, then it would be probably better to do it on ETFs. Now you can see that if you were to sell a cash secure put, let's say right at the high, right around 2007, you will see that it takes quite a long time before the market goes back up again, right? From this point of time when the market crashed all the way to where it finally recovered, it took over 10 years, right? It took over 10 years. So one way to mitigate this risk is to split your entries into tranches, and that is the final tip for making the options wheel strategy safer. So what do I mean by splitting them into tranches? So basically, let's say you have enough cash to sell 3 cash secure put, let's say at the $30, right? So that means you need to have a capital of $9,000. So let's say instead of just selling 3 cash secure put all at this one level, you split them up into 3 different levels. So maybe you could sell one at the $30 level, sell another one at $25, sell another one at $20. So this way, if the market was to really go down, right, you would be able to average down your price. So it makes it easier for you to break even on your stock and then make money on all the premiums which you sold, right? All the cash secure put as well as the covered call. So this way it's much easier to break above 25. So if you were to, long 100 shares at each of this level, your average will be 25. So it'll be much easier for it to go above $25 than it is, to go above $30. So let's do a quick recap on what the wheel strategy is, right? So the wheel strategy basically starts off by selling a cash secure put with the objective that we want to get assigned on this 100 shares, right? So once we get assigned on the 100 shares, we're going to sell our covered call. And then on the covered call, we want to have our shares called away, and then we will go back to selling the cash secure put again, and we'll do this over and over again. So basically, this is the wheel strategy. Now, in the previous video, I talked about only these 2 income sources, basically just to get a premiums from selling cash secure put as well as a covered call. So for example, this is the stock right now, and then we'll be selling an out of the money cash secure put. All right, cash secure put, and then the market
hopefully was to go below the cash secured put, and then we'll be assigned on this cash secured put. So we'll be now long 100 shares, and then we'll be selling a covered call at the very same strike price, so that when the stock goes up, and then we'll be assigned on the covered call. That means our 100 shares will be called away, and this way we'll be back to square one again, where we sell a cash account put again. So in this case, we do not make anything on the shares because we are essentially buying and selling at the same price. The only income which we'll receive is from selling the cash account put and the covered call. But for this video, we're going to be talking about the third income source, which is capital gains from stock. And usually the gains which you get from the capital gains of the stock would be higher than the premiums which you receive from selling the cash account put and the covered call. So basically it will be something like this. So this time, right, we'll be selling a cash account put, still out of the money as well, but this time as the stock goes down, now we get exercised. Now we are long 100 shares. So this time, instead of selling the covered call at the same strike price, we're going to sell our covered call above our entry price for where we are long the 100 shares. So this way, when the stock goes up, right, we will be assigned on the covered call, so our 100 shares will be called away. So we'll be making money on the cash account put, making money on the covered call, and we'll be also making a capital gains, right, from our underlying stock as well. So when you're selling the cash secured put, we are basically earning extrinsic value, right? Because we're selling out of the money put options, and for the covered call, we'll be selling out of the money call options. So this too will be extrinsic value. But the capital gains from the stock, this would be intrinsic value, because in a stock position, 100 shares is always 100% intrinsic value. So in this triple income option strategy, we'll be having a very good mix, a very good profit mix of extrinsic value and intrinsic value extraction. Now next, let's talk a little bit about entries and exits. Right, so the first thing we're going to talk about is selling the cash secured put. Now when I'm selling the cash secured put, we always want to have a margin of safety by entering only when the stock is oversold. So when the stock is oversold, basically this is the indicator which I use is stochastic. So when the stochastic has a reading that is oversold, then that is when I start to sell the cash secured put, because I do want to ensure that the moment if my cash secured put get assigned, that there's a good chance for the market to go back up, right? So it's much better for you to enter when the stock is oversold rather than when it's overbought, right? So because when it's overbought, there's a higher probability that the market is going to go down, right? So we want to be much more smarter and strategic in our entries, and we also want to enter when there is a support level. So I'm going to explain this later on in the chart. And the third thing that you want to do, so this is a little bit of advanced concept, which is to stagger entries into several levels, right? So if you have enough funds, so let's say for example you have $10,000 dedicated to this stock to do your wheel strategy. So instead of putting all 10k into one level, you want to split them into several levels, right? Maybe you split them into 3 levels. So you put in $3,300 for each level. All right, so that means you want to look for stocks that are around the $20 to $30 range, right? Because when you do this, you will increase the probability of generating the triple income at lower levels, right? So for example, let's say you sell the cash account put, okay? And the market goes up and then it goes down. Let's say it goes down and it takes a long time for it to finally come up. Right, it goes down, dwindle. So during this period of time, you can't really make anything, right? Because the stock may have gone so far down that you're not able to sell a covered call at your break-even point at the very least, right, or even higher. So you get stuck down here. So instead of doing this, you want to be splitting them into 3 different levels. So basically, what you want to be doing is something like this, right? Let's say you sell the cash account put, first level. So once it comes down, you sell another cash secured put down here, and if the stock continues to go down, right, you sell another cash secured put. So this way, even though if the market doesn't recover, right, to the first level, at least this first few levels, you're still able to sell covered calls to try and get more profits, right, to get some profits going on down here. So I'll show you a little bit more in the charts. Now, The thing to take note is that there's a trade-off. That means that you won't make as much if the stock rallies after filling at the first level compared to one entry level. So this is what I mean, right? So let's say, for example, the stock was to just dip into your first level of your cash account put, right? So let's say this is just one entry. If it comes down here, all right, let's say you are now assigned 100 shares, and then the stock goes up. So perfect, everything is good down here because you only have one level. But if you had three levels, let's say you have another two levels below down here, now it doesn't get filled on your two levels, so that means that your profit is only 1/3 of what it should be, right? Because if you had a single level, you will put, let's say, $10,000 in your capital into this level. Let's say, for example, you have allotted $10,000 for this strategy on this trade, right? But if you were to split into three levels, right, this would be only 3.3k, right, 1/3 of it, and then this will be another 3.3k, and that means you only have 1/3 of the size. As the market goes up, that means your profit is being reduced by 2/3, right? So that is the trade-off. Now I'm going to go through some charts so you can take a look at it later. Now next is selling the covered call. Now covered call, basically what you want to do is sell only when the stock is overbought and also above a resistance level. And if you have several cash account put, you can stagger your cover calls into several levels. Now this will be on a discretionary basis, so as you see the market goes up, you can just place the cover call as the stock goes up. Now I've also created a video on the cover call, the blueprint on the strike selection, so you can go ahead and watch that. Alright, so let's get into a trade example. So this is for the single entry level, so you can get a better understanding of what I mean here. So we can see down here, what we want to do is wait for the stock to be oversold first. So as you can see down here, this is oversold, and then the market is down here. But the thing is, there's no support level here. So where's the next nearest support level? Is around this price, right? So this price is around 135. So what you want to do is you want to sell a cash account put either at this level or slightly lower than that, right? If you're more conservative. So I tend to be more conservative, so I want to sell at 130. So that's what I'll do. So I'll place a cash account put at 130, and from this point on, what we'll do is just wait and see what happens next, right? So the stock continues to go all the way down. So indeed, it went past our cash account put, and let's say at this point, our cash account put gets assigned, right? We get assigned and we are now long 100 shares. So the next step, what we're going to do is we just have to wait for the market to go back up a little bit first so we can start selling the cover call. So at this point in time, the market went up. Now there is an overbought, right? You can see it's overbought on the stochastic. So this is where we want to sell our cover call. So down here, now when you're selling the cover call, you can of course sell at 130, right? You get more premium. But the thing is that although you get more premium, you do not get any capital gains from the underlying stock. So what we ideally want is to get a capital gain from the underlying stock, right? So instead of selling our cover call at 130, we'll be selling at 135. So this way, if the market goes up and it closes above the cover call, right, at expiration, then we'll be getting this profit down here as well. So once we place the cover call, next thing you do is just wait and see what happens. So the stock unfortunately went all the way back down again, right? At this point in time, you can see it's oversold. So now that it's oversold, there's no point for us to keep the cover call because we have probably made quite a bit of the profits or the premium that we received from the cover call. So it's time for us to close this cover call. So what we'll do is we'll go ahead and close the cover call. So at this point, we wait for the stock to go up again, wait until we receive or we see an overbought signal, and then we sell our cover call again. All right, so this time we sell at 135 again. And then subsequently, you can see the market gapped up, although on a very negative or rather not so good earnings. As you can see down here, the market did gap up, and then at this point in time, we just wait to see whether we are assigned on the cover call. If we are assigned on the cover call, that's good, right? Our shares get called away, and then we can sell our cash account put. Basically, just wait until the stochastics go down again, and then it becomes oversold. We can sell our cash account put. If it doesn't get us called away, it goes down here, back down again. What we can do is we can sell another cover call, and then just wait again. Right, so basically this is the single entry level. Okay, now what about multiple entry levels? So this is what I mean. So instead of placing one cash account put, we will be selling multiple cash secured put as the market drops. Now remember, there is no difference to the risk allocation, right? In the single entry level, if you had $10,000 allocated to that stock for the wheel strategy, then you'll be putting all $10,000 for the cash secured put, right? That's assuming $10,000 is also part of your portfolio size, right? Maybe you have like $100,000, right? Let's just say, for example. Now, for the multiple entry levels, if you have allocated $10,000, you do not change the amount. So instead of putting, $10,000 to one of this, right? So now in this case, realistically, because this stock Amazon is 12,000 or $13,000 if you were to get filled on this. So realistically, you need about $40,000, right, for 3 levels. So instead of $40,000 you put into one level, what you want to do is to split them into multiple levels. So this is how it works. Again, you can see this is oversold. All right, so you'll be selling your cash secured put on the first level. Then we'll wait for it to see what happens. So at this point of time, the market went down. So when it goes down below the first cash secured put level, now we can sell a second cash secured put level. Now, where do we place the second cash secured put level? We're going to put it roughly around 5 to 10% apart, right? So in this case, it's close to 10%. So let's take out our calculator here. So let's see what do we have down here. So just 15 points, right? So 15 points from 130 to 115 divided by 130. So this is roughly 11.5%, right? So it's 11.5% difference from here to here. Okay, so we're going to be selling a cash secured put level 2 at 115. So once we sold this, we wait and see what happens. So as the market drops even lower, we now sell our third cash secured put level, right? So level 3. So we split our allocation for this stock to 3 levels. So after these 3 levels, we do not enter anymore. If the market subsequently goes all the way down, what we're doing is we'll be holding on to the stock until it finally recovers, right? So once we have sold this cash secured put level 3, now what we do is just wait and see what happens. So let's say at this point in time, let's say we are now assigned on our cash secured put level 1, right? So now we are long 100 shares at $130. So at this point in time, there's nothing to do. We just wait and see if the market goes up or goes down. So at this point in time, the market goes up. Now it is overbought. So what do we do when it's overbought? That's right, we sell a covered call. So as you can see, we sell a covered call at 135. Right, so this time we can get a capital gain in case the market does go up and then it closes above our cover call. And if it does, cash secured put level 2 and level 3 would expire worthless. This way we'll be able to gain the full premium which we sold it for. So let's see what happens. So in this case, the market went back down. So as it went back down, what do we do once we see that it's oversold? We can close our cover call. So we go ahead and close our cover call. And let's say at this point, our cash secured put level 2 has been assigned to us, right? So now we are also long 100 shares at 115. Now when we do this, we want to ensure that we see them as 2 separate orders, right? 100 shares here and 100 shares at this point, because we're going to be selling cover call separately for these 2 different levels, right? On your platform, they may merge it as one order, right? They will take it as 200 shares and they will take the average price at probably around 122.5, right? So you need to keep a log of this on your spreadsheet so you know exactly where you went long. Okay, so at this point in time, cash secured put level 3 has still not been breached. So at this point in time, this is still considered out of the money. So let's see what happens next. So let's say, for example, at this point in time, our cash secured put level 3 is now expired. So now when it's expired, what do? We can always sell another cash secured put down here. So we sell a cash secured put, and let's take a look at what happens. Now that it has gone up, right? Again, now we have this overbought signal. What do? Now we sell covered calls. Right now we sell cover calls. Now we can sell 2 cover calls because we have 200 shares. We can sell a cover call for this and we can sell a covered call for this. So remember, as I mentioned earlier on, we can stagger our exits just as the same way we staggered our entries, right? So we can stagger our covered calls on the way up. So in this case, you may want to sell a covered call at 135, and then you can sell a covered call at 140 as well, and then just wait and see what happens, right? So in this case, as you can see, if the market goes up and it closes above this 2 covered calls at expiration, then we're going to have our this 200 shares called away. So we're going to be making a lot of profits in this case, right? Because we'll be making the premium from the cash secured put, which we sold from down here, cash secured put here, and the 2 cash secured put that we sold down here, right? We sold 2 cash secured put down here, and in this case, we'll be also receiving our cover call profits from this, and where we sold one earlier when the market went up somewhere down here. We sold one cash cover call down here. At the same time, we'll be getting our intrinsic value gain from the underlying stock, our capital gains, right? So maybe this will be considered the intrinsic value gain, the capital gains from this price to this price, 115 to 135, and then for this from 130 to 140. So this will be the capital gains here. So as you can see, when you split them into multiple entry levels, yes, there's more things to do, but it also means that you have a higher chance of more profits, right? Because you no longer get stuck in a position compared to before, right? Before, if you had just only one order at this price, if the market just stayed below down here and does nothing, you pretty much, for a period of, let's say, from May all the way to maybe even August, right, there's really not much you can do in terms of selling that much premium or even getting any intrinsic value gain, because the market has always gone below the entry price of where you got long 100 shares, right? But then if you were to split them into multiple entry levels, you can see that it's much easier for you to gain on any of this, right? So let's say in the event if the market did come down here and then now you're long 100 shares, guess what, right? If this gets up here, down here, you can start to sell another cover call. So you'll be making profits at the bottom level first. So even though if the first 2 levels have no chance to get any intrinsic value gain from the underlying stock, your last level can always have a chance for you to gain the intrinsic level. And let's say the market just bounces back and forth at the bottom, right, for a long time before it eventually goes up. Then guess what? Then your third level will always be making the cash secured put, and then the intrinsic value from the stock as well as the premium from the cover call. So you have the triple income just on the last level alone before you can gain the triple income from the other 2 levels. Alright guys, this is quite a little bit to take in, but I want you to go back and rewatch this part again if you're not very sure. But this is a very good way for you to ensure that you're always getting something as the market is moving, right? As the market goes up and down, especially if it continues to go down, right? If you split them into multiple entry levels, you're ensuring that you're always getting an income at the lower levels. If you were to just keep them to just one level, just like the earlier example which I showed you, just for example, if you were to just sell this level, just level 1 without anything else, then if the market goes all the way down here, you're not going to be getting anything, right? So it becomes much more strategic, much better in my opinion, if you have enough funds, of course, to split them into multiple levels. Now, for the wheel strategy, selecting the right stocks plays a very big part, right? It plays a very big part in the success of the overall strategy, especially right now where the market is crashing. So, for example, if you get assigned on your cash secured put and you become long 100 shares and the market subsequently crashes, well, it may never go back up to your entry point, right? Depending on the kind of stocks that you choose. So, when the market crashes, though everything just drops, right? No matter what kind of stocks that you're holding, any kind of equity you're holding, is just going to drop quite a big amount. So as you can see, a number of stocks right now have really crashed even up to 70%. So if you had your cash secured put somewhere up where the market kind of peaked, right? For example, if you sold your cash secured put somewhere down here, and then the market after that has crashed significantly much below your entry point, what happens right now is that you are stuck with 100 shares and you may face the problem where you're not able to sell a covered call at the entry price or above your entry price, right? So the only other thing that you might be tempted to do is to sell a covered call below your entry price, maybe somewhere here. And while you can do that, the risk is that if the market was to suddenly rally on some kind of a news which the market perceives as very positive, it may become very difficult for you to roll the covered call up, and you could be locking yourself in a loss, right? So this will be the loss which you'll be taking if you cannot roll your covered call and the market actually expires, outside above your cover call at expiration. So that is the risk that we always have when we are doing the wheel strategy. So that is why when you're selecting stocks for the wheel strategy is very important. You have to choose the kind of stocks that in the long term, at least it will still go back up. So while we want to have high volatility, right, to get the high premiums from selling our cash secured put and cover call, you also want to choose stocks that will go up in the long term. So especially right now where the market is crashing, you want to ensure that you have a stock that, even though if you are long at this price down here, in the end, if the stock eventually does go back up higher, you can still get out of this position rather than you're stuck with a stock that may not necessarily go back up. So when it comes to wheel strategy, there are two methods that people usually use, right? The first method is the most common one, which is basically focused on, purely on extrinsic value gains, right? They just want to go for the stocks with the highest volatility. This way they can sell the cash secured put and the cover call with a lot of premium, right? They get a lot of premium, but these stocks may not necessarily be fundamentally good stocks, right? They may not necessarily go up in the long term. Now, the next method is to be focused more on intrinsic value and moderately high extrinsic value gains. And I say moderately high extrinsic value gain is because it is considered high, but not necessarily as high as stocks where it's focused purely on extrinsic value gains. So what I want to do is I want to get into details on both of the methods so you can decide for yourself which you think is better for you. So for the first method, this is focused purely on extrinsic value gain. So you are only looking for stocks purely based on high volatility, right? All you have to do is just search for stocks that gives you very high volatility. So as you can see, these are your meme stocks like your AMC and your GameStops. And this is AMC option chain. As you can see down here, the volatility is pretty high. I mean, the premiums that they give will be pretty high because your volatility is quite high. You can see they are in the hundreds of percent, right? 198%, 300%, 200%. So this is considered pretty high. That is why you can get pretty juicy premiums. But the problem with such kind of stocks is that it can have very big wild swings, right? As you can see, the stock has gone from somewhere around like what, $2, it shot up to around $44, and now it has gone all the way back down to $6, right? So if you were to somehow sell a cash secured put, maybe let's say roughly around $32 at this point in time, then it becomes a little bit uncertain whether the stock is going to go back up, right? We never know, is it going to go back up or is it going to continue going back down? So when you choose this kind of stocks, although you're going to get very high premium, right? You get high volatility, that's why you get high premium, but we're unsure whether you can actually get back to your entry price if somehow you get assigned right before the market really crashes. So for this kind of stocks, you do need to have very strong chart reading and market timing skills, because if you time it at a place where the market subsequently collapses, then you're going to get worried because you're not sure whether the market is going to go back up. Now, one of the factors to determine whether the stock will actually go up in the long term is whether it has strong fundamentals. So strong fundamentals basically just mean whether the company is profitable in the long term, right? Has it been profitable before? Has it been consistently been growing its revenue and its profits? So if you were to take a look at AMC's income statement, you can see that the revenues and income is pretty much all over the place, right? So you can see that in 2017 to 2019, right, you have pretty flat revenue. After that, it has a drop, then it increases. But in terms of the income, as you can see in this yellow color, the profitability is all over the place, right? You lose money here, you're slightly positive over here, but then you're negative here, and then you start to lose money in 2020. 2021, you're also still losing money. So this becomes a little bit of a question mark whether this market, or rather this stock, will sustain, right? Will it still be around the next 5 years in case, let's say, the stock just dwindles around the price right now of $6, right? If it stays around here, $6 for the next 5 years, we don't even know whether this stock is going to go back up to your entry price. So it becomes very uncertain. Now, that is not to say that it may not become profitable in the long term. Of course, there is a chance, right? If AMC changes the business model or AMC becomes profitable in the long term, then the stock can eventually go up. But as of right now, it is a big question mark, right? Because as of this moment, it is still unprofitable. So that's why the future of this stock is uncertain. So while you may have very high premiums from selling all the cash put and the covered call, you may get into a situation whereby, like right now when the market is crashing, you're stuck with a position and you are very uncertain whether the market is going to go back to your entry price. All right, so method number 2 is to be more focused on intrinsic value and moderately high extrinsic value gain. So this is the method which I tend to use because I know that my market timing is not that good. I might get into a stock where the market, maybe I sold a cash account put here and then the market starts to crash, right? And if the market crash, I want to have this room for error, which I have, right, for the stocks, that it will eventually still go back up. And the only way for it to go back up is that if the stock has good fundamentals. So this is, as you can see, is the stock of Apple. Apple is one of those stocks where I think it has good fundamentals and it will always go higher in the long term because so far it has done so for the past many decades, right? So now in terms of the volatility, as you can see, it's not as high as AMC. All right, it's only about 49 point something percent, but it's actually still pretty decent. Right now the market is crashing, so there's quite a little bit of volatility in the market, so that is why this can be also a very good candidate for the wheel strategy. So for this method, to focus on intrinsic value and moderately high extrinsic value gains, there are 3 criteria that you want to look out for. So first, you want to have good fundamentals. So good fundamentals, basically there's increasing revenue, increasing profits, and generally we want the assets to be more than the liabilities, right? If the liabilities is more than the assets, then there's a chance the company can go bankrupt. Now, criteria number 2 is strong technicals. That means to say the company has been around for several market crashes, and every time after a crash, it still continued to make new highs. So this way we know that they are pretty resilient, right? We know that if they have survived number of crashes before, if they've survived like 2, 3, 4 crashes before, we know that right now in the current market situation, if the market crash, there's also still a good probability, a good chance that the market can recover in the long term. And also we want a moderately high volatility, right? So this is where you want to choose tech stocks instead of consumer staples. And I know right now tech stocks have been beaten very badly because the Fed has been increasing the interest rates non-stop, trying to control inflation, which is also why the tech stocks have pretty high volatility compared to other kinds of stocks, the consumer staples, right? So I want to get into a few examples. So a few examples, it would be Apple. So as mentioned before, Apple is a fundamentally good stock. So as you can see, as of now, the lowest that it has gone to is negative 29%, right? It has crashed roughly 29%, but it has recovered slightly and starting to go down. So right now from here, we have no idea what it's going to do. Is it going to go up? Is it going to continue to crash? We never know, right? So there's definitely more downside to go if it continues to crash. But what's important to understand is that it is a profitable stock. So as you can see, this is the income statement for Apple. Now, this is a huge contrast to the one you saw on AMC, right? So for Apple, you can see that the revenue is generally increasing over the long term and it's been profitable every single year. You can take a look at the net income. Again, the net income is also profitable every single year and it's also slowly, gradually increasing. So we know that Apple, at least in the long term, if you get caught in a position where the market has crashed from where your entry price is, at least we know that in a number of years time it will still go back up, right? It has a good chance of going back up rather than you being uncertain about it. So let's take a look at the past. So Apple is no stranger to crashes. So as you can see in the past, it has crashed quite a number of times. You can see that in 2008, right, although it looks like a very small retracement here, that's only because Apple has really gone up right after that, right? So, but during that, back then, 2008 was the financial crisis, everything crashed, right? So it crashed 61%, but in the end, it still made higher highs, right? It survived the crash, it became stronger. After that, it crashed again, right? 45% crash, but then it made new highs again. And this time it crashed 34%, but then it made new highs again. So at the current point where it stands, the lowest it has crashed is 29%. So there definitely is a chance that it may crash, right, to as low as 61% in the past. Right now, of course, it may not necessarily definitely crash. Who knows what the market is going to do? No one knows, right? But we do know is that even though if you get caught right at the high, right, at least you're not going to lose that money if you just hold on to it, right? That is also one of the reasons why when I enter into a real strategy, I don't just have one entry, right? I don't just have one cash secured put and then, I just leave it there until they get assigned and then I just sell a cover call. Instead, I try to have many levels. I plan out to have many levels just in case the market crashes. And I talk about this in another video as well. All right, the next example will be Google. Again, Google is another tech stock. Again, you can see that it has been taking a beating as well. It is down 36%. But the good news is that Google is also a fundamentally good stock. As you can see, increasing revenue, increasing profits as well. And Google, like Apple, is no stranger to crashes. If you take a look at 2008, it has crashed 67%. But the important thing to understand is that the market has survived the crash. Right? Google has emerged stronger even after it has such a huge drawdown on the stock. It became stronger only because Google is profitable. Now the last stock is Microsoft. Now Microsoft right now also has taken a beating. Right, it's down 33%. But Microsoft as well is a profitable company. Again, you can see it has very strong income statement. It's a very strong fundamentals. You can see that the revenue is increasing year after year. The income is also increasing year after year. That is why even though there are crashes, Microsoft will still recover, right? So as you can see, in 2000 all the way to 2009, it has the biggest crash ever, and this lasted almost a decade, even longer than a decade for it to finally come back up to the highest point. So even though if for some reason you manage to get yourself into a cash secured put position, you assign yourself 100 shares down here, right, your money isn't lost. It's just that you lose out on opportunity cost of making all this money during this time, but then you still get your money back at the end of 17 years. But the thing is that the market, although has crashed 75%, right, Microsoft has gone down 75% from its high, it still manages to make a new high eventually. And then you can see back then it was like $84. It's already considered so high. But if you take a look at the stock right now, it's about $237. Even went to a high of $340. So that is why when it comes to the real strategy, you want to be quite smart when you choose the stocks that you want to do it, right? So if you want to go more for high premiums, you can definitely do that. But do keep in mind that you do need to be pretty right on your entry price, right? You need to be good at your market timing, because if the market is to crash, you're going to be uncertain, right? You're not sure it's going to go back up. But if you go for stocks like Microsoft, these are all fundamentally strong and good companies. You know that although your market timing is not good, you still have room for error, because in the long term, it can come back up, right? So you can take it as though it is an investment. So again, there are many ways to make the wheels safer, the wheel strategy safer, and the way that I like to do it is again to split it into many different levels, right? Wait until the market is oversold, then you start your first level, your second level, your third level, your fourth level. Basically, you want to space them out by percentage or by dollar terms, and basically you just have more chance of making it work rather than you have just one. So this way, if the market crashes, right, you can still have the other levels to generate more income for you. First of all, let's talk about this traditional wheel strategy, right? So the basis of this wheel strategy is to simply just sell a cash secured put at a single level. Then once if it's exercised, you sell the cover call, rinse and repeat, right? So for example, right, you take a look at the chart. So most people, when they enter into the wheel strategy, what they do is that they will try and use technical analysis, right? They will try and take a look at the chart and they see that, oh, this is in an uptrend, so I want to sell a cash secured put somewhere below the last low, right, the previous low, or below the moving average, or wherever it is that they think that the market would rebound after going back down for a while, right? Ideally, they want to sell a cash secured put and that it never gets filled on the cash secured put. That means the market never goes below there, they never get assigned on the 100 shares, and they just get the premium, and they just want to keep doing this, right? So I'm going to give you an example. So let's say you have $10,000 in capital to use on the wheel strategy, right? So maybe this 10,000 is part of your big portfolio, or you just want to commit 10,000 to just a single stock for this stock to do the wheel strategy. Now this is on AT&T. Now first of all, I'm not saying that you should use it on AT&T. I'm just using this as an example because this is actually quite a low price stock, right? So this is easily doable with just $10,000, right? If you want to do this on Google, you will definitely need much more money. You want to do this on Amazon or any other tech stocks that are much more expensive, right? $10,000 is definitely not enough. All right. So for this example, let's say you have identified that you want to sell the cash secured put at $19.50. So this is the level you want to sell your cash secured put at. So hopefully you want the stock to just stay above this cash secured put, right, at expiration. Then you just collect the premium, right? You don't have to go through the hassle of getting assigned on it. So if you have $10,000 in capital, what you'll be doing is you'll be selling 5 cash secured put, right? Because each cash secured put, right, let's say if you get fulfilled 100 shares of the underlying stock, you will need to put up $1,950 in capital. So it's roughly $2,000 per cash secured put, right? So since you have $10,000 in capital, you can afford up to 5 cash secured put. So even though if your 5 cash secured put gets assigned, you have the money, right? So this is the goal down here. So you sold the cash secured put, $19.50. You sell 5 of them. So let's say the stock goes down and it closes at $19 at expiration. So at this point of time, you will be assigned on the cash secured put, right? And then now you'll be long 500 shares. So at this point of time, what you want to do is you're going to sell 5 covered calls. So you're going to sell 5 covered calls. So in this example, I choose to sell it at the same strike price as where you sold the cash secured put. So in this case, all you're doing is just earning the premium from selling the cash secured put and the cover call. So total, you have like 10 short options that you're receiving premium on, which is going to be pretty nice in terms of income. So you sell the 5 cover calls at $19.50, and let's say if the stock goes up and closes above $19.50 at expiration, what's going to happen is that your shares is going to be called away, and then your position is back to zero, and then you do this all over again, right? So basically this is the ideal situation which you want when you're doing the wheel strategy, right? Now here's the problem. What if the stock actually continues to drop further and further after you got assigned on the 100 shares? So as you can see in this example, this is AT&T. What happened if you sold the cash secured put at $19.50? So as you can see, the market went all the way down here. So at this point, this is quite a big problem because it's going to be hard for you to sell a covered call now, right? If the market is way below your entry price of where you are now long 500 shares, you're not going to get much premium for selling the covered call. So what do you do in this case? There are only 2 options that you can do. If your current stock price right now is way below your entry price, you can only either cut loss, which is take the loss, which is something we all want to avoid when we are doing the wheel strategy, or to just simply hold on until the stock comes back up. But the problem is that you may have to hold for many years. In fact, I've spoken to some of you guys, I've spoken to some of my subscribers, they have emailed me regarding some of their situation, and this is not uncommon because the market has just recently crashed. Right now we are in a bear market, so a lot of the positions which most people have is that they face something like this, right? So they are long somewhere almost at the highs, and then the market has just crashed all the way down, right? Certain stocks have even crashed more than 50%. So at this point of time, there really isn't much you can do if you don't really have any more capital, right? You could try and sell covered calls, right? At this point, let's say from this point, you could sell your covered calls below your entry price, but then you will be risking your stock to be locked in at a loss, because if there's suddenly going to be a rally, let's say there's some news out there, let's say maybe the Fed decided to ease up on a quantitative tightening, or suddenly the war stops, or whatever news that comes up that the market sees as very positive, the market can just suddenly rally, and it's going to rally past your covered call. And if it's going to rally very hard, very quickly, it's going to be difficult for you to roll up and out each time, because that is the only rolling strategy that you have, right? Just keep pushing to the further dated months and rolling to a higher strike price. But if your entry price is so far away from where the current stock price is, you could end up locking in the loss, right? So if you have a covered call at this point, this level down here, this cover call, and you realize that you can no longer roll out and up, then guess what? You have already locked in this loss from where you entered to where your shares will be potentially called away. So this is one of the big dilemmas that you face when you are doing the traditional wheel strategy, where you only enter with a single level. So what is the solution? Right, so the solution is the income grid wheel strategy, and this is what I'm personally using when I'm using the wheel strategy. So this is the income grid wheel strategy. So the income grid wheel strategy, the difference is that you do not sell the cash secure put at just a single level. Instead, you sell the cash secure put at multiple levels, and we have multiple levels of cash secure put. It means that you can sell your cover call at multiple levels as well. So this way, you will always be able to sell premium even if the market crashes, right? So the whole idea is to just keep selling your cash secure put at different levels. So this way, regardless where the market is, there is always a chance for you to keep selling premium. So let's get into a similar example. So let's say you have $10,000 in capital as well. So again, remember, when you're using the traditional wheel or the income grid wheel strategy, the risk doesn't change, right? It doesn't mean that you're using the income grid. Therefore, if you're placing more multiple levels, you want to increase your risk. No, it shouldn't be that way. The first you always start off with is the risk, the maximum risk or the capital that you want to allocate to the wheel strategy, right? So it doesn't change. Always prioritize how much you want to allocate to the strategy first. So similarly, we have $10,000 in terms of capital to use for the income grid wheel. So instead of just placing all 5 cash secured puts at just this single level, what we're going to do is we're going to split them into different levels, or rather, like, it's like grid, right? You have different levels throughout the stock levels, right? So you have level 1, which you will activate first because this is the closest to where the current market is. So you only sell the first cash secured put at $19.50, just only one cash secured put. So this way you still have more capital for level 2, 3, 4, and 5. So when the market goes below this cash secure put, right? So at $19.50 is your cash secure put. So if it goes below here, what you can do next is to activate the next level by selling the next cash secure put. So you sell the next cash secure put. Let's say you have decided that the second level is $2 away, right? So it will be at $17.50. So at this point of time, you can sell another cash secure put at level 2, $17.50, and let's just say that the market just stays in within, just stays between these two lines, these two strike prices, and it expires there. So what happens is that your first cash secure put at the first level, $19.50, it will be assigned and you will be long 100 shares. At the same time, your cash secure put at the level 2, $17.50, it will expire worthless. So you have captured the full premium for this. At the same time, you already received the premium for the first cash secure put down here. So what do you do right now? So what you can do right now is to do a covered strangle, right? So I've covered this in a previous video. If you haven't watched that, go ahead to watch that. I'll put the link at the top right hand corner. But basically, the covered strangle is just simply selling a cash secure put and a covered call at the same time, right? So you can just sell the covered call at $19.50, which you got assigned 100 shares on, and then you sell the cash secure put again at $17.50. So this way you still get income. Okay. Now, what happens if the market crashes again? It just drops below your second level. Now, in the traditional wheel, what you are left with is that you're stuck with this position, right? You may be able only to sell the cover call one time, but then later on, it's going to be very difficult for you to sell the cover call at your entry price. Instead, you may have to resort to selling, below the entry price, which I don't really suggest because it can be, quite tricky, especially if the market rallies. But then for the income grid wheel strategy, you still can utilize your other levels because you have already planned for the levels all the way down to $11.50. So it has only dropped to $16.50. So at this point of time, activate level 3 cash secure put, sell it at $15.50 at this level, and then you have your third cash secure put. So as you can see, if the market stays there at expiration, what's going to happen is that the first level is going to expire your cover call. So now you're still left with long 100 shares. And at this point, you cannot sell your cover call down here anymore because it's just too far away. It's not going to yield any premium, right? But then you have this second level cash secure put, which got assigned. Now you can sell a covered call at this level, right? So you can sell a covered call at this level, and you can sell another cash secure put at the $16.50 level. So now you're selling another covered strangle. So here you have level 3 activated again for you. So as you can see, when you do the income grid wheel strategy, you are pretty much factored in how far the market might crash, right? You do not know where the market will go, right? No one really knows. We can only kind of use technical analysis or indicators to just give us an indication of where it might go, but really no one will know, right? So especially now that the market is crashing, we are in a bear market, the market wants to go down. So when you use the income grid wheel strategy, you're kind of protecting yourself in a sense, right? So as you can see with AT&T, even though after the huge gap down and the market just continues to go down, guess what? You're not out of business in a sense, right? You can still continue to sell premium over and over again, compared to if you were just stuck with the 500 shares previously. There's nothing you can do, right? You cannot sell any covered call. But in this case, notice that you still have 2 levels that you haven't used yet, right? So that means your mindset is going to be quite good, right, compared to if you had just 100 shares. So when I approach trading, mindset is actually very important, the psychology which you have, because if you had just, all your cash secure put sold at this level, guess what? You're going to feel very painful as the market continues to crash, continues to tank, right? But if you have this income grid wheel strategy, you're not going to be that afraid, right? Because you have still more levels down there, because you know that no matter where the market goes, even though if it crashes down again further down, you're still always able to keep selling your premium, right? You can keep selling your cash secure put at this level, level 2, level 3, level 4, level 5, over and over again, and you can even try and get some intrinsic value gains on your stock, right? Because as the market does rebound back up, let's say if the market rebounds back up, you could sell your covered call at above this entry price of $17.50. So let's say maybe you want to put a covered call at $18.50, and if the stock really closes above this level, not only do you get all the premiums from the cash secure put and the covered calls, but you also get the intrinsic value gain from where you entered at $17.50 to where your shares got caught away here, and then you can go ahead and sell another cash secure put again. So basically, wherever the market goes, right, you have this grid that is really covering all the possible moves that the market can make, right? So you want to make this to, as far down as you think the lowest the market can go, right? So let's say, for example, if you think the market at 50% is the area which you think that it's hard to go below, right, then you can put the last level at the 50% mark. But again, it all comes down to how you want to construct it. There's no one way that's better than the other. Alright, so as good as this income grid wheel strategy is, there's of course some cons as well. So I want to go through the pros and cons to compare both the traditional wheel and the income grid wheel, so you know exactly the difference between these two and which is more suitable for you. So let's first go through the pros for the traditional wheel strategy. So first off, the pros is that you make more money if the cash secure put expires worthless, or if the market goes up after the cash secure put is assigned, right? So you notice that, when you sell the traditional wheel, you will go 5 cash secure put, right, at one time. So let's say, for example, this is the stock, right? It comes down here, and then you sell the cash secure put. There's 5 cash secure put you sell because you have 10k capital, and the market really goes up, right? If you're good at market timing, the market goes up, guess what? You're going to receive the full premium on the 5 cash secure put. So that is why you make more money compared to the income grid. Because remember, with the income grid, you are splitting it up into different levels, right? So the first level will never be fully using up your capital. So you will not be making more compared to the traditional wheel if the market goes up. Secondly, for the traditional wheel, it's not as capital intensive as income grid wheel, because you can just sell 1 cash secure put. So for example, let's say if the stock is $100 and you have $10,000 in capital. So in this case, you can actually sell 1 cash secure put on that stock, right? $100 times 100 shares, that's $10,000. So you can do the traditional wheel strategy there. But if you want to do the income grid wheel to have at least, if you want 5 levels, that means you need $50,000. Or if you want 3 levels, you would need $30,000. So that's going to be very capital intensive for the income grid wheel compared to the traditional wheel. So traditional wheel is much less capital intensive, and it does better when the market is in an uptrend. As mentioned, if the market is in an uptrend, even though if the market goes past this cash secure put, if it goes up again, doesn't go down further, then your 5 cash secure put, right, just a single level, is going to do much better than the income grid wheel. So the traditional wheel, in a sense, what it does is that it prioritizes profits. That means all you are trying to focus on is how much money you can make. So that is why the traditional wheel is quite popular among a lot of people, because they want to try and get as much premium as they can upfront. All right, so let's take a look at the income grid wheel, the pros. So for the income grid wheel, the pros is that there's no need to time the market well, as you have more room for error with many levels, right? So with the traditional wheel, since you have only a single level, you need to be pretty good with your market timing, right? Because if you enter the cash secure put and the market starts crashing from there, then guess what? You're going to be stuck with a position, holding on to it until it finally recovers. But with the income grid, you have room for error because you have already have a plan for many levels below the first cash secure put level. So this way, even though if the market continues to drop, you're actually happy, right? Because if the market drops, that's how you can actually start to make more income, because as the market drops, you will get filled on the other levels. So because of this, you'll be able to always sell premium to get income, right? Even if the stock drops a lot. So especially if right now the market is going down and then you have some positions that you already did the wheel on and it's way up there, your entry price, there's nothing you can do. But with the income grid wheel, this prevents that from happening, because you kind of factor in the worst case scenario, or rather a very bad scenario if the market crash. So this way you will keep selling income. There's always income coming in, money coming in, as you sell this cash secure put and cover calls other levels. So this does better when the market is in a downtrend, right? So this is the opposite of traditional wheel. Traditional wheel, you want it to be an uptrend. Income grid wheel, you want it to be in a downtrend where the market keeps going down, which is the current market condition which we are in. So the income grid wheel is much better right now because it prioritizes risk. We do not think of the amount of money that we make, but rather the first priority that we think of is, oh, how far can the stock actually possibly drop if I'm wrong? So if I'm wrong, where do I want my lowest level to be? So this way I ensure that I still get some income as the stock drops, right? So it is a very different mindset from traditional wheel. Let's take a look at the cons for the traditional wheel. So for the cons, right, as mentioned, you need to time the market well, or the position may be stuck for a very long time. I've spoken to a few people. They have their position stuck since January or February of this year, which is about 7-8 months ago, and they can't sell a cover call at their entry level, right? So if you want to avoid that, then the income grid will be better. Now the cons of this is also that you're not able to sell any premium if the market drops a lot, right? So as I mentioned, if it's too far down, you cannot sell anything, and it's bigger risk to the downside because your average price is much higher, right? Now what about the income grid? The cons of the income grid, well, the cons is that you actually make less money if the market goes up after placing your first cash secure put level. So the psychology here for the income grid is that you actually do want the market to come down, because as the market comes down, you get to sell the other cash secure put level, and that's how you make your income. Ideally, you want all 5 levels to be activated so that you can keep selling the cash secure put and cover call all throughout as the market moves, right? With the traditional wheel, you pretty much have just one chance, right? One chance, one level, right? One level to make it right. And then if you're wrong on this and the market just crashes from there on, then there's not much you can do. But for the income grid wheel strategy, you have many levels, right? You can go 5, you can go 6, 7, up to the cost of the stock, as well as how much capital you have. So this way, even though if you're wrong on the first one, it doesn't matter, right? Imagine if the market just moves this way throughout, right? You're just going to keep selling your cash secure put and cover call all throughout all this level as the market just goes up and down and just go back and forth like a pinball, doing nothing much. Even though it goes sideways, you're going to keep selling premium, keep receiving that income over time, and carry you through this tough period. So the cons is that less capital at work if the market doesn't drop to the last level. So at one of the thing to try and maximize your profits is to always use your capital when it comes to investing, right? So that's why there's this dollar cost averaging. You want to always put in a consistent amount every single month, so this way you're always putting into the market and always have exposure to the market, so that in the long term you'll be making money, right, as the market goes up. But with the income grid, you
only have, you're placing this level. So if the market just touches the first level and goes up, and every time this happens, you're only utilizing, 20%. Let's say you have 5 levels, you're only using 20% of your capital at work. So you're only going to earn the return on the 20% capital, but you have 100% put into this whole trading, investment, right? So your returns will not be as good as the traditional wheel. So again, there's a catch, right? There's always a trade-off. In an uptrend, traditional wheel is better. In a downtrend, income grid is better. If you are prioritizing profits, traditional wheel is better. You're gonna get more off each level. But if you are prioritizing risk, you're worried about your downside, the income grid will be better because it really manages risk and ensures that you get income even though if the market crashes. All right, so let's take a look at some takeaways. So the traditional wheel strategy is more aggressive in prioritizing profits, as mentioned earlier. But the income grid wheel strategy is more defensive, right? Your mindset is more towards, okay, how far can the market drop if I'm wrong on the first level, right? So it prioritizes risk. Next, the traditional wheel strategy requires better market timing because you only have one level to play with. So you need to be good at reading charts, seeing technical analysis, looking at indicators, right? But for the income grid wheel strategy, it gives more room for error, right? You don't have to be exactly right. In fact, you can just place the first level, and in fact, you want the market to drop so that you can utilize the other levels as well. So there's much more room for error, and timing is less of a concern when you use the income grid wheel strategy because you can plan your grid to very far down. Next, the traditional wheel strategy works better when the market is in an uptrend, right? So it maximizes profit at a single level, cash secured put and covered call as well. But the income grid wheel strategy, it works better when the market is in a downtrend because that's when you'll be able to activate all the other levels. So this ensures an income even as the market drops a lot. So which one is better? The answer is that there isn't one that is better, but rather you want to choose one that suits your psychology the best, right? And of course, based on your capital and also the price of the stock, right? So if your concern is wanting to make the most profits, then you want to go with the traditional wheel strategy, right? This is the one that most people are using. Just sell one level. They can just have many different stocks and then just sell a single level. So this gives you the most profits. But if your concern is that the market is going to crash and potentially, having to hold on to the stock for a long time without being able to sell premium like right now, then you want to go with the income grid wheel strategy. Okay, so as you can see on this left hand side down here, this is a chart. This is the current price of where Amazon is. It's around $92.50. So this is where I first started looking at Amazon, and that's where I started the income grid wheel strategy. So the next thing you want to do is how you want to plot your levels, right? So when you use the income grid wheel strategy, you want to plot all the levels in advance. You need to know exactly where you're going to sell your cash secured put. So you know exactly also what is the maximum cost, or rather the risk that you have to put into this stock for this strategy. So as you can see for this, what I've done is that I've started off with the $90 level, right? So this is my very first level, the $90, and I've plotted the income grid levels every $5. So every $5 down, I will have one potential cash secured put to sell. And the next thing you want to do is to identify the very last level. Where is the last level that you're going to sell your cash secured put at, right? So for me, I've decided at the $40 level. That means that the market has to crash roughly 80%, right? So $40 is roughly at the 21% mark of from where its high is. The peak is around $188.65. So at $40 is roughly at the 21.2% level. So the market has to crash roughly 80% for me to get filled on all this cash secured put. And as you can see in the previous history, you can see that the market has actually crashed 95% before. 2008, 66%. So there is always the chance that the market can, crash all the way down to around $40, right? We never know. So I just want to prepare myself in the event that does happen. This way I can still keep selling premium, because right now, in a market condition where it's a bear market, the market wants to crash, I want to put myself in a position where I'm not just stuck on one level, right? So that's one of the biggest problems which many people have in 2022.
is where they sold a cash secured put. Maybe let's say, for example, they sold at $110 and the market just kept going down after that and it never recovered, right? So they have a problem right now because they are stuck with this level, $110, and they cannot even sell their covered calls because it's just too far away. So with this income grid wheel strategy, you're pretty much preventing this problem because you have grid levels all the way down, right? You have all this potential level for you to keep selling premium, keep selling your cash secured put and covered call. So imagine if the market was to just, bounce back and forth, like ding dong back and forth for the next, like what, 2 to 3 years, especially if you remember the period from 2000 all the way to 2010. It was a decade of sideways motion. The market never really made a new high for those 10 years. So in the event, let's say for example, right, touch wood, this happens again, at least I'll be in a position whereby I'll always be selling premium rather than just waiting for the 10 years later for the market to eventually go back up. Now, of course, I could be wrong, where the market could just, reverse and go all the way to high. So for me, that's fine as well, because I've already got other positions. I've got long-term stock holding. So while I do not make any money on this, I still have money on my long-term stock holding. So this way, I'm pretty much diversified in my strategies, hedged in this case. So if the market crashes, no problem. I've got this income grid wheel strategy working for me. If the market rallies all the way up, no problem as well. I've got long-term stock holding which will benefit from. On top of that, you can always readjust these grid levels if the market goes up. For example, right now, let me just remove this choice. Let's say if the market goes all the way back up, right? You can decide, hey, all right, I'll readjust my grids, right? This income grid level. So the first level is now $800, and then the next few levels, so on and so forth. So all this you can always just readjust and plan, and that's the beauty of this income grid wheel strategy. Now, for the income grid wheel strategy, next thing you want to take note of is the cost that you need to put aside for this. So for me, I've decided to put aside $80,000 just for this Amazon, because my account is fairly big, so I just dedicated a small portion of it to this stock for the wheel strategy. So for you, you want to decide yourself as well. The main thing is that you do not get caught in the position whereby you realize you run out of money once the market has gone all the way to this point, right? You realize that, oh no, I do not have any more money for this, or worse, you actually got filled on all this and you realize you don't have enough cash. And what's going to happen is that if the market continues to crash, you're going to get margin call, and then you need to put up more money, and this is where all the problems starts to arise. So the very first thing you need to take note of is what is the cost that you need to set aside to put up all the levels which you want for the income grid wheel strategy. Now, if you think that you don't have $80,000 to set aside for this strategy, you of course do not have to plot your income grid levels this way. You can always adjust them, right? So for example, you may say instead of a $5 grid level interval, you may do a $10 one. So this way, you have it at $90, you have it at $80, $70, so on and so forth, right? So you can go all the way back down also again to, in case the market crashes, 80%. And then you can see the total cost is about half of the previous one. The previous is $80,000, this is about $43,000. So you can still partake in selling the premium even though if the market crashes, right? Because you still got all these different levels that you can just keep selling your premium, sell your cash secured put, sell your covered call. All right. Now, what if you still do not have this $43,000? You still want to make it lesser, the cost lesser? Then, of course, you can always adjust it. That means you do not have to put your levels to these two levels, right? So previously, you can see we have the levels all the way to $40. This time, you can choose to say, hey, maybe I don't think the market is going to crash that much anymore. I think 80% is a little bit too exaggerated, especially now that Amazon is a much stronger company, a much different company compared to when it was in the year 2000, right? So I think that the market maybe at most will crash 70%, right? Or maybe even to 60%. So in this case, you might just say, I just only want to go all the way to $60 or maybe $70. So in this case, you can see that the cost outlay that you put is only $30,000, which is much lesser than the one which we did earlier, right? So it is very flexible. It is according to your own outlook and also your own capital outlay risk factor that you want to do for this income grid wheel strategy. All right, so the next thing that you want to take note of or to understand is when and where do you sell your cash secured put, right? So for me, I like to sell my cash secured put once the price gets close to my strike, right? Some people like to sell it,
far away. Let's say maybe when the price is at $100, they want to sell it at $90 already, right? That is perfectly fine. There's no written rule to say that you must sell it once it's get close to the current strike price. But the reason I like to do it this way is because as the price gets closer to the strike price, I get more premium, right? As long as it's closer to your strike, the more premium you can get, right? So the other thing also is that because I have many different levels, right? I have at 85, I have at 80. So as much as possible, I want to wait for the prices to go as close to each of these strike to maximize the premium which I get. Again, this personal preference, you can choose to sell all these 3 or all these 4 at all the levels as much as you can at one time, right? Some people, they like to say that, okay, the market right now is $92, and then I want to sell the cash put at 90, I want to sell the cash put at 85, I want to sell also at 80. So this way they get all 3 premiums, much more premium than you would sell one by itself, right? That's perfectly fine as well. For me, again, I'll wait until it goes lower to sell, because if the market really does go lower, then you would probably regret selling that early, because you would have gotten more premium if you had just waited a while. Now, on the other hand, of course, the market could have just gone up, right? If the market really just bounced up, then you would have been better off. You have gotten more money, more premium if you sold all this, 3 or maybe even 4 strike price at one time, right? For me, again, as you know, I like to sell it down here because the chances of you getting good premium at around, the far out of the money strikes is very little, right? And if you want to get any decent one, you want to go very far out. Okay, now the next thing is that you want to decide which days to expiration you want to sell the options at, your cash secured put, right? So you have so many choices. Which one do you want to sell it at? So I'll pull out a few different choices. You can see you have the one at 2 days expiration where you get $77. You have the 9 days, you get $202. And then you have the one at 30 days at $360. So what's the one thing that you notice is that as the days to expirations gets higher, it's actually the premium actually kind of gets lesser because it's not proportionate, right? For example, let's say this 2 days give you $77. So if you were to just do a simple calculation, you'll notice that if you would take 2 days to make it to 9 days, the premium you should get much more than $200. So for example, right, let's say if you just take this premium rate at $77, you divide it by 2, and then you times 9 days, you should get $346.50 for this, right? If you were to take the same premium per day you get on this 2 days to expiration, but instead you get less, and you get even lesser if you go all the way to down here, right? So let's say, for example, you take the 9 days. 9 days times 2 will be 18 days to expiration. So by just a simple math calculation, you should get at least $400 or more if you're going to have the expiration date at 30 days away. But no, you actually only get $362, which is much significantly less than 2 times of this when there's so many more days out. So the thing with this you need to understand is that although the premium in terms of dollar terms is small, the return you're going to get is much lesser. So I'm going to give you a simple way for you to just calculate the returns you're going to get for each of this premium. So let's say for this, right, so remember each contract has 100 shares, so 77 cents just means it's $77. So what you want to do is take $77, you divide off, right, by the cost which you're going to put up in case your cash put gets exercised. So you have to put up $9,000 to be along 100 shares. Then you divide it by 2 days, the number of expiration date. Then you times 365 days to annualize it. So if you annualize this, you can see it is 1.56, which is 156%. Right? So 156% based on this premium on this date. Now let's take a look at the one at 9 days. Right? So again, same thing. You take $202, divide by the capital which you have to put up for this strike. 9,000, you divide it by the days to expiration, then you times 365 days to annualize it, and you get 91%. You notice this is much lesser. You get 156% for this, 91%. Now, 91% is still a lot, right? You get annualized 91%. If you can imagine you can keep doing this consistently, which of course is not possible, you will get a pretty good return, right? Now, let's take a look at the one at 30 days. So this is where it really starts to drop in terms of your return, right? So you get $362, you divide by the $9,000, you divide by your 30 days, you times your 365 days. So now you have a 48.9%. So you can see the return drops, right? But your premium, of course, in terms of dollar terms is more. So which do you actually choose to sell, right? So the quick answer is that there is no right or wrong. You can just go for anyone which you want, right? So it really depends on your own objectives. So let's say, for example, if you want the highest return on interest, right, the highest return on your capital, then you definitely want to go for these 2 days, right? I've got some people who are telling me, saying that, you know, they go for the shortest time frame possible, the shortest days of expiration, because they get the highest return. This way they can keep selling the premium. Yes, that is absolutely right? You get much higher return, but the problem is that what if the market actually crashes after you sell that? Because if the market crashes and it doesn't come back up to your 90 strike price, then you can only sell this once, so you only got $77. And this is where you have regretted, because you wish you have sold two for this day's expiration, the 9 days, because you would have gotten $200 for this, or you wish you have sold this because you got $362, which reduces your cost basis, right? So you never know what's going to happen, but of course it could just go up, right, expire, then it comes back down, you sell again, it goes back up, expires again, comes back down, then you sell, then you can just keep selling this. Again, we never know where the market is going to go. So for me, which one I chose? I chose the one in the middle, because generally I kind of like a good high return, but at the same time I do want to have quite a decent amount of premium. So in this case, I generally go for above $200 for this price level. So $200 is actually a pretty good premium, pretty decent premium for this. And also there's only 9 days left to expiration. So I sold this, and then let's just fast forward and see what happens. So on the expiration day, on 11th November, you can see that the market actually clearly expired above our strike price, so we gotten the full premium for this. So at this point in time, two choices. You can either just sell the premium right now at 90 strike price if you want to, if you're aggressive. I prefer to wait, so I waited until the market goes down. So when the market get closest to my strike price, $90, this is where I start to pull out the option chain again and see which one to sell. So again, you have three choices. Which one you want is purely up to you. Alright, I chose for the one in the middle, and in fact for this I actually got filled for $2, because at this point what I did, I put a limit order for $2, so as the market went down, I got filled at $2, right? So I got $200 for this. Right, so let's fast forward. So again, at expiration day, 2nd December, you can see that the market clearly closed above our strike price, so it expired. So again, two choices. Either you can choose to sell now or wait for the market to go lower. So I waited for the market to go lower, and by this time you should know that I generally only look at the second closest option that is closest to expiration, right? So I do not really go for the first one, I go for the second one down here. So for this, again, I received over $200. So again, you want to see what happens at expiration day. So expiration day, you can see it closed below our strike price this time, and I got exercise for the 100 shares. So now I'm long. I have to put up the capital of $9,000 to buy this 100 shares. Now at this point in time, there are people that actually ask me, do I roll this short put as it's close to expiration, right? Do I close this cash secured put? In this case, I actually do not roll the short put, right? I do not roll my cash secured put, and the reason is because when you're rolling this short put, what you're actually doing is that it's pretty much the same as if you get exercised and then you sell a cover call at 90 strike price, right? It's pretty much the same, all right? If this stock, Amazon, has a put skew, then you would get slightly more premium than selling a cover call. But for me, I do not want to roll my short put down here, because my intention is to wait for the market to go up to around $95. Then I sell a covered call at this strike price. Remember, when you are assigned on your stocks, there's two ways that you can make the money. Number one, you can sell your covered call immediately at the same strike price, so this way you just get the premium. The second way is by selling the covered call above where you're assigned at, so this way not only do you get the premium from the covered call, but you also get the capital gains from the difference of where you got assigned and where your shares will be called away in the event where the market continues to go higher, right? So for me, I prefer it this way, especially because Amazon is so undervalued right now. I don't think it's that difficult for the market to eventually go above $95. So this is where I'm headed towards. This is what my intention is for this, but it's perfectly fine for you as well if you say, hey, you know, you want to roll the short put to get more premium in case the market goes lower. That's absolutely fine, and that's your decision to make. Now, so I pull up the covered call down here, I pull up the call options down here to show you that you also have the option right, to sell a cover call once you get exercise, right? So once you get exercise, you can immediately just sell the cover call at the 90 strike price and then get some premium here, right? If you sell the 7 days, you get $105. If you sell the 14 days, you get $173. All right, so totally up to you again. All right, so for me, I waited. So the market went down. So if you had actually sold the covered call down here at 90 strike price the moment you were assigned, then, well, you would start to make some money right now on your covered call because the market has gone down. All right, so the next step is to sell your cash secured put at the next level. So as you can see, I do this step by step, batch by batch. So at this point in time, again, there are two options. You can sell it, right, the 4 days to expiration. You can sell it at the 11 days to expiration. I'm pretty sure you know by now which one that I went for. So the one I went for, again, would be the one at 11 days. So I sold this. All right, let's just fast forward. And as you can see over here, the market has closed below our strike price at expiration, which means I've actually gotten exercise at 100 shares. So as of this recording right now, Amazon is at $83. So this way, I'm now long 200 shares. And again, I'm not selling my covered calls yet. I'm waiting for the market to have a bounce to go closer here. Then I'll sell my next covered call. So this covered call, if I sell at 90 strike price, would belong to this 85 strike price. And then if the market goes higher again to 95, I will sell another covered call at 95, which belongs to this $90 strike price. So that is my plan. So as you can see down here, as of this recording, I've got 2 positions filled. All right, this 2 cash secured put, and the beauty of this is that I still have so many more levels to go. So at this point of time, I actually want the market to go lower. Not that I'm a party pooper or that I want, you know, the market to crash, but I'm just trying to prevent myself from getting caught in a position. Let's say, for example, if I just had one level 90 and the market goes down, I cannot sell any more premium, right? So a lot of people are pretty much stuck at the position. I want to prevent that. So I prefer to spread it all out in different levels. So this way, as you can see, I'm actually excited if the market continues to go down, because this way I can make more money. And as you know, that as the market goes down, the volatility actually goes up. So as the volatility increases, the premium increases as well. So as the market goes down, I'll be making much more premium on all these levels. At the same time, my return is higher because the premium increases, but then the capital outlay, as you notice, is getting lower and lower as it goes down. And as it goes down all the way to the $45 and $40 at this point, and hopefully it does, right, I'll be able to actually sell 2 contracts down here, which increases my premium as well. So as long as the market just keeps staying in within my grid levels for this wheel strategy, I'll just keep selling premium over and over and over again. Alright guys, this is the income grid wheel strategy on Amazon. So I will encourage you to try it and make sure that you really plot out these levels first, and you know in advance what your cost is going to be, and that you have this set aside for this wheel strategy, so that you do not get yourself caught in the position where you run out of capital and then you're going to get margin call. So as you can see, this was where we last left off in the last video. So at that point in time, we have been exercised, right? We've been assigned on the 100 shares at $85. So at this point, we have 200 shares, right? We have 100 shares at $85, and then we have another 100 shares at $90. And since then, Amazon, as you can see, have really rallied, right? It has gone up quite a bit. And this is where you can really start to take some profits off the table, right? You can sell cover calls, and I'm going to share with you the decision making process that I went through as the market went up. All right, so let's go back a little bit to where we last left off in the last video. So in the last video, it was mostly just cash secured puts, right? Because the market basically has just gone down, right? It hasn't really rallied up that much, right, compared to how it is right now. So in this video, I'm going to be sharing with you the covered call. So now at this point in time, where the market, right, is roughly around $82 plus, after you got assigned on the 100 shares, you can actually choose to sell a covered call. So there are some people that, you know, all they want to do is they just want to sell covered calls at the same strike price which they got assigned, right? So they got assigned $85, they want to sell the cover call, and there's absolutely no problems with that, right? So what you're essentially doing is you're just trying to get the premiums. You're just getting premiums over and over again, and you just don't care about the capital gains, right? Capital gains is where, you know, if you're assigned at 85 and you sell the stock at anywhere above $85, you're going to have capital gains on top of the premiums which you receive for selling the covered calls. So at this point of time, let's say you decide that, you know, you just want to get the extrinsic value because you're afraid that, you know, the market might just continue to go down, and you want to quickly get, you know, whatever premiums that you can get, you know, to cushion this downfall in the prices. You could actually do that as well. So if you were to pull out all the call options at this point of time, you can see that there are a number of choices, right? So the strike price which you want to go for will be 85 because that's the price you would have get assigned at, right? So at 85 you can see that there are many different choices, right? So which one do you want to go for? And here's the short answer: there is no right or wrong, right? You're still going to get the premium, you're still going to make the money. So as long as Amazon goes up in the long term, you're going to be making all this premium, this income, as long as, you know, you just keep doing them consistently. So at this point of time, which one do you want to sell? So here are a few insights, all right, for you on how I decide which one to sell. So first off, you may want to consider, you know, selling the one which has the highest ROI, right? Some people want to say that, you know, I want to get the highest return, the bang for the buck on my investment. So if you want to go for that, this is how you want to calculate the ROI. So first of all, you want to take the premium. So let's say, for example, you take the one where there's 1 day's, you know, there's 1 day left to expiration. So that's about 39 cents. All right. So you take the 0.39, and then you just divide it off by the strike, which is 85. And then what you want to do is divide by the number of days to expiration, right? So in this case, there's just 1 day left. So 1 day left, there's no need to divide it, and you just times 365 days. So as you can see, this is roughly 167% return, right? 167% return is really a lot, right? If you think about it on an annualized basis. But then you need to think that all you're receiving is just $40 for this one time. Now, what if the market continues to go all the way down? Let's say, for example, if the market kind of really tanks after that, then you would have kind of regret that you didn't sell, you know, further days to expiration, the further one where you get more premium, right? Because you could only sell this once at this moment, right? That's just $40. But if you had sold the one at you know, the 29 days to expiration, you'd get $436, right? $436 per contract, and this is actually quite a juicy premium compared to the one which there's 1 day, right? And the other thing that might happen is if the market was to really just shoot up, which, you know, eventually did, right? So in this case, again, you would have your shares most likely called away at 85 strike price, but then the only premium which you receive is just $39, right? When you could have maybe gotten more, right? 436. But then of course, you know, the market could have gone down back then by then, but hey, at least you have gotten $436 in terms of premium. So these are things that you really want to take into consideration when you're, you know, choosing the right strike for you, right? Again, there is no best strike, right? Because you never know what the market is going to do, right? The only time I would say that, you know, this 1 day left is good if you were to sell at the same strike which you got assigned is if the market just stays somewhere around here, right? It just stays somewhere around here the next few days, and then after this expires, you can sell it again, right? You can just keep selling and selling and selling it over 1 day, over and over again, or the next expiration date, once this expire, for you to keep getting the highest return on your investment, the highest ROI. So we never know what's going to happen. You just want to choose one that you feel comfortable with. All right, so let's take a look about the ROI for the second one. As you notice that as more days there is left to expiration, the ROI will actually drop. So there's kind of a trade-off. You get higher premium, but you get a lower ROI compared, you know, to the shorter DTE option. So let's take a look at this one. So you take 1.68 and then you divide it by the strike price, 85. So this time you divide it by number of days left, which is 8, then you times 365 days, you get 90.17%, which is pretty good as well. And let's take a look at the last one. All right, so you get 4.36, and then you divided it by
the same, the strike price, you divide by the days to expiration, that's 29, and you times 365, that gives you a return of 64.55. As you can see, the ROI drops off, although you get slightly more premium. So there's no right or wrong answer. You choose one which you are comfortable with and you can live with, depending on where the market goes after that. All right, so for me, I did not choose to sell the cover call at 85 because if you have already seen my last video, my plan was to sell it at every interval, right? At every grid interval. So this income grid interval is $5. So what I want is that when I get assigned on this, I want to sell my 85 strike shares at $90. And those at $90 that I've been assigned these 100 shares, I want to sell at $95. So this way, not only do I get the covered call premiums, I also have a chance to get a capital gain of the difference, right, of this strike prices. So in this case, it's $5 difference, so that is $500 if my shares get called away at the next level. All right, so again, for this, there are always trade-offs, right? It's not saying that this is better, it's just that, I think that Amazon right now is pretty undervalued, and at the same time the stochastics, which is not shown here, is actually pretty oversold. So I know there is some sort of a bounce that is due soon, and if I expect that there's going to be a bounce that is due soon, why would I just want to sell it at the price where I got assigned when there's a chance I can get it at a higher price, right? So this is my consideration when I did it. Now of course I could be wrong, right? The market could go down and then I would have regretted not selling at this, or rather I would have gotten at least more premium if I had sold it at this strike price at 85, right? So at the end of the day, again, it comes down to where the market is, all right? So as you can see, the market rallied all the way to $90. So this is where I took a look at the cover calls, and this is where I decided to, sell my cover call. So again, I'm faced with three choices, right? You have the 3 days, you have the 10 days, and you have the 31 days. Which one do you want to go for? Right, so for me, the decision which I made, I actually went for the shortest one. I went for this one. And if you notice in my previous video, I actually chose, for the cash secured put, I chose the second nearest expiration date, right, instead of the first one. But for the cover calls, I chose the shortest one. And the reason is because, well, firstly, if you can see, the premium difference is not that great, right? So as you can see, for 3 days, you receive $190. But for 10 days, right, which is roughly 3 times, right, of this days to expiration, I only receive $257, or rather I would only get $257. That is much lesser than twice when I should be getting at least 3 times this premium. So there's not much difference. So the other thing, that the reason that I chose this is because right now I don't just have the premium of this cover call that I'm going to receive. I'm also going to receive the capital gain from 85 to $90. And as much as possible, I want to capture this profit, right? Because this is a pretty big profit compared to the premium which I'm going to receive. So the last thing I want is for the market to go back down again when I already had a chance to sell it at a profit for the capital gain side. So I wanted to get out of this position as quickly as possible to realize these capital gains. So that is my first priority, right? So that is why I chose the shorter days to expiration. Now, if you wanted to choose the longer ones, right? Because if you believe that the market is still going to go up all the way in the next 30 days, then there's nothing wrong going for the 31 days. You get $555. So you get $555 on top of the capital gains of $5, right? So all comes down to your own expectations you have in the market. I chose the shorter one. All right, so in this case, I actually put a limit order for $2 because I wasn't able to stay or rather stare at the market throughout the whole market, all right, close, right? At the open of the market, I only trade for like an hour or two. It didn't reach this price. I just put a limit order and I wake up to see if I get filled or whether it does not get filled. So in this case, I only got filled the day after, right, when the market shot up after that. So that's where I got filled. So I sold a cover call at the 90 strike price at this $2 in terms of premium with 3 days left to go. Okay, so as you can see, I got filled at the next day, right? The next day you can see the market really shot up, went all the way to $95. So at this point of time, it actually gave me the opportunity to sell my next covered call, right? So the next covered call, that I sold will be at 95 strike price, and this time I'm able to get at the same days to expiration, the same date of expiration, and there's 2 days left to go. So you can see the market really did a U-turn, very strong rally in the next few days after we got a sign. All right, so again, down here there are a few choices that you can go for. So again, for this, I went for the shortest expiration date because I want to get exercised, or rather I want to have my shares called away at $95. So this way I also gain the capital gains from $90 to $95, and I have 2 days to go for it. And at the same time, if you were to take a look at the stochastics, which is not shown here, the stochastics is showing that the market is going into the overbought region, and there's always a chance that when there's such a strong rally, right, there tends to be, you know, quite a little bit of a pullback first, you know, before eventually the market goes up, or maybe it goes down, right? So if I wanted to get out of my position and I expect that there could be some sort of a pullback, then I want to get out of my position as quickly as possible, because this way, if the market does really rally, if the market does go back down after my shares get called away in the next few days, then guess what? I can again sell the premium. Let me just remove this drawing. If the market goes up and then comes back down again, and then I get exercised or have my shares called away in time, it comes back down, I can sell my premium again, the cash secured put, at $90. It goes further down, I can sell it again at $85. So this way, I'm always trying to maximize the premium which I receive when doing this income grid wheel strategy. So for this, I did it at 95 strike price. I sold the cover call at 95 strike price, and I got $2. Again, I just placed a limit order, and then I just went away from my computer. All right, so there's no need for you to actually stay in front of the computer, because you're not doing day trading, right? This is not day trading. This is more of a longer term, mid to a long term trading strategy. All right, so I chose the one that is at 95 strike price at 2 days, and for a $2 premium. So as you can see, the market continued to rally, and at this point we got our shares called away. So that is a very good news for us, because we managed to get the premiums. On top of that, we got capital gains from 85 to 90, and then we have the capital gains as well from 90 to 95, and all we have to do right now is just wait for the market to either come back down before we initiate at the $90 again, or if the market continues to go up, then I may reassess the whole situation again and then adjust the income grid. All right, so if you've seen in the last video, my income grid started at $90, right? Because the time when I take a look at Amazon, when I decided to do the wheel strategy, the price was roughly around this bar down here, right? So I waited until it went down to 90 before I started the income grid. Now, if the market was to continue to go up, right, then I may readjust the income grid. So that's the beauty about the income grid wheel strategy. You can adjust according to your own expectations of the market. You can adjust, you know, if you feel that you want to capture more profits as it's closer to the market. There's no right or wrong here. It's all really up to you. Okay, so let's take a look at the total profit so far. So for the cash secured premium, the profit so far which I received from selling them, it's about $850, and then for the cover call premium, it's $400. So just from the premiums alone, I've gotten roughly about what, $1,250, and then from the capital gains, you can see it's quite a hefty return as well for an additional $1,000, and that is $2,250 in total for this income grid wheel strategy, and we only got, you know, filled on just these two levels. All right, so hopefully the market could still continue to be bouncing back and forth around these few levels. So this way we can always just keep selling the premium. All right, now the next thing I want to bring up as well is one of the subscribers which I had, actually a few of them have asked, you know, regarding where does the rest of the capital or the money, where do you put it, right? For example, for this grid, let's say you have the income grid, you have a few levels, right? So let's say you have a few levels. Let's say, for example, you go all the way down to $50, right? So at this point of time, you notice you only get to use two of this level, sorry, at $90 and at $80. So only these two capitals is being used, but the other capitals below $80 is not being used. So what do you do with them? Are they just being set there idly, or do you do something with it? So For me, I personally put them into fixed income securities, or what you call money markets. So this way you're actually getting interest in the short term, right? You're getting interest before putting your capital to use. So this way, right, it doesn't sit idly there. Otherwise, it will be pretty much just rotting away in terms of a return, because right now in the current interest rate environment where the interest rate is pretty high, you do want to have your money working for you. So it's only when the market goes much lower, then you activate the other capital which you have. But then again, this is your own choice. This is something, your own decision. You could just put all the capital you want into your trading account and then just use them solely for trading, or you could just put them in the fixed income securities or money market. So this is what you can consider doing. In terms of what fixed income securities, what money markets, this is something you want to go ahead and research for yourself, because different countries have different kind of securities, right? If your own country, you have your treasury bills, you have your maybe you call it fixed deposit, time deposit, that just gets guaranteed interest at expiration, right? This is something you might want to explore for yourself, right? So alright guys, so I hope you found this video helpful, give you an insight of how you too can do the income grid wheel strategy for yourself.
So if you have a trading account of roughly $10,000 to $25,000, then this is for you, right? So you can still do the wheel strategy even though you have a limited capital, right? But if you have anything lower than $10,000, then it's going to be a little bit difficult to do the wheel strategy. So I would say you need roughly around $10,000 to $25,000 to be able to get started in the wheel strategy. For the wheel strategy, for small accounts, there are two methods for stock selection, and this is something that I've already covered previously in another video. But just for a very quick overview, basically there are two methods when people do the wheel strategy, right? So the first method is to focus purely on the extrinsic value gains. That means all you're concerned about is getting as much premium from your cash secured put and your covered calls. So the stock selection for this is pretty straightforward and simple, and that is to look for stocks with very high implied volatility, right? Because the higher the implied volatility, the more premiums you're going to get, and that's what a lot of people want to do when they're doing the wheel strategy. But for me personally, I do not go with method 1. I go more for method 2 because I want to be focused more on intrinsic value. That means I want to ensure that the stocks that I choose will have a very good chance to go up in the long term, right? That it will always go up in the long term, as opposed to stocks which are mainly for high IV. They could be like your AMCs, right? They will go like all the way up, then all of a sudden they will just dwindle down there, and there's no prospects of whether it will go back up to the highs, right? So if you were to get into a cash secured put somewhere here and then you got a sign, you're not sure whether the market will eventually go up, right? It's a question marks, because a lot of these companies, they are not profitable yet. So if they're not profitable, we're not sure whether is the market going to, continue buying the stock to push it up. At the moment right now, it's still uncertain. But whereas if I go for stocks which have strong fundamentals, then there is a higher chance that the market will always make higher highs and even survive past crashes, right? So I'm more focused on this method where it's more for intrinsic value and it has moderately high extrinsic value gains. So basically I also go for stocks that are tech stocks. So these tech stocks generally have higher implied volatility compared to other types of stocks like consumer stocks and all that, right? So that is for method 2. So basically for this, I look for stocks with moderately high IV plus strong fundamentals and history of surviving crashes. So there is much more work to do compared to method 1, because method 1, all you have to do is just use any stock scanner, look for high implied volatility, and you just decide which stocks you want to go for. But for method 2, you have to really dive deep into the stock itself. You want to know that the stock has actually good fundamentals, and by that I mean there's increasing revenue, it's increasing profits, they have strong free cash flow, the assets are more than the liabilities, right? And also it has the history of surviving crashes, right? Has it survived, the 2000.com crash, survived 2008 crash, the pandemic crash, and everything has gone higher since. So this is the method I go more for. In fact, it's the only method I use for my investing, for my trading as well, because I want to have the comfort of knowing that there's a good chance that the market will always go up, especially right now when the market is crashing. If you are caught in certain stocks where you do the wheel strategy, there's high IV, and you're caught like maybe AMC, maybe you got it down here. Right now, you're not sure whether it's going to go back up, right? So it's very uncertain. So I prefer the safety net that the market has a better chance of going up in the long term. That is why I go more for method 2. Now, when doing the wheel strategy, diversification is very important, right? Because the last thing you want to do is put your funds into just one position and the market tanks and you run out of funds to continue the wheel strategy. Because if your funds are very limited, you may have very little options in terms of stocks, right? Your stock selection will be much lesser. So let's say, for example, if you only have $10,000 to play with, let's say you only $10,000 for the wheel strategy, and you found a stock, say maybe Starbucks, right? Starbucks maybe is around $80. So what that means is that you can pretty much only have one position on, right? Because one position, if you sell a cash account put on it and you get exercised on it, you're going to get long 100 shares, and this $80 is going to be basically $8,000 in capital. And with a $10,000 capital, you only can have one position, right? But what happens if the market continues to crash after you entered into this position? Then you basically be stuck, right? You can only sit on your hands and you cannot get into more positions, and you've stopped your ability to get income, right? Which is what the wheel strategy really is about, right? The wheel strategy is about just generating income over and over again over time, right? You can always be selling cash account put and covered call, but if you are stuck in a position where your entry price is so high, let's say your entry price is over here, this is where you entered your positions, right? Your entry price, and then right now the market has crashed all the way down here. Right, at this point of time, you cannot sell any covered call at this price because it's just too far away. There's not enough premiums. And I've spoken to a number of people have emailed me asking me what can they do, whether they can sell a covered call below the entry price. Now, while that is an option, it is always a risk, because if there's a chance, let's say for example, there's some news that really moves the market, right? It could be news that, maybe the war stops or the Fed stops the quantitative tightening. The market may take it very positively. It may really rally up, and at this point of time, you can't really roll your cover call up. So you become stuck in a position where you have this loss, right? You're stuck in this loss from where you entered and where your shares get caught away. So while you could do the cover call below your entry price, is a little bit risky, and generally I tend to stay away from that. But I do know that some people actually do that, right? So when it comes to wheel strategy for the small accounts, diversification is very important, right? Because you want to always ensure you keep getting an income regardless where the market goes, right? If you get stuck in one position, then who knows when the market is going to come back. If the market is going to come back maybe in the next 2 to 3 years, it means to say you can't get any income for 2 to 3 years. So that is why before you get into the wheel strategy, you want to plan this very well in advance. So when it comes to diversification, there are two types, right? You have horizontal diversification, and because there is limited funds in your small account, I would say that you want to go for ideally 3 to 5 low to no correlation stock or ETFs with one position each, right? Again, you have very limited funds. So you want no correlation, low to no correlation, because if the stock of all the stocks that you chose are all correlated, well, if one was to crash, then all is going to crash. So it's as though you just have one stock position, right? So it's important to have to understand the stocks that you're in, that they are not really that correlated, right? The other diversification is vertical diversification. That is to have just one core stock or ETF with multiple entry levels each. All right, so this is the horizontal diversification. So basically, you have 3 to 5 low to no correlation stocks or ETFs with one position each. And let's say you have $20,000 in account. So maybe this is what you might want to do, right? You have 4 stocks with allocation of around $5,000 each in 4 different sectors, right? Hopefully, they are all uncorrelated or not as correlated as possible, right? So maybe you have one in the tech sector, you allocate probably $5,000. You want in the healthcare, 5,500. You have one in the consumer, right, 4,500, and another one in the financial sector, $5,000. And the thing is that although they may have not that much correlation, right, let's say you choose 4 stocks that are not that highly correlated, but in the event that the market crashes, when the market crashes, everything will sell off. So that is why it's also important to not enter all these 4 positions at one go, right? You may want to enter it, stagger it by timing. So maybe, for example, when the market has really tanked, you see that the broad-based index, everything is dropping, you might want to enter into the technology stock first, right? Enter into technology stock. Now, all these stocks have probably crashed as well. It has gone lower, right? But you do not want to enter them as well. So maybe you want to wait maybe a week later. If the market still continues to drop, then maybe you enter into the healthcare, and then maybe another few days go by, the market drops even further, you get into the consumer and then the financials as well. So this way, you do not get trapped in the position whereby, you know, if you were to enter it all on the same day, all roughly at the same time, if the market is going to crash tomorrow or the day after, well, all these stocks are all going to go down, right? If they're all going to go down, you're going to be trapped in all this stock again. So it's the same thing. You may get trapped in all these 4 positions, right? Let's say you got one position here, another position here, another position here, another position here. This is cash secured put, by the way. You sell the 4 cash secured puts, all on the 4 different stocks, and then the market continues to crash, right? All of them crash. As we know that right now, as the market is crashing, everything goes down. Nothing is really going up. Even bonds are crashing. So when this happens, you're gonna get into a real world of pain, right? As a lot of people are experiencing right now. And you may even get into a position whereby all 4 of them, you can't even sell the covered call, right? So rather than do this, what you want to do, let me just remove all this drawing. What you want to do instead is enter this first. If the market crash, right, then you enter the other stocks, right? Enter this one, then maybe this one, maybe it starts to drop even further, so this will drop along with it. Then you start to sell another cash secured put on another stock again. So maybe this time the market suddenly rallies, right? It goes up, and this one goes up as well. This one goes up. So at this point of time, you cannot sell cover call on this because it's too far away. But guess what? You can sell cover call on this, right? So you imagine if you already get assigned 100 shares, you can get a cover call exactly at the entry price. So this way you get the premium for both the cash secured put and the cover call. But for this, guess what? Your cash secured put might just expire worthless. Or maybe you're lucky enough, you get assigned already before the market rallies, and then you can sell a cover call above. So this way you get both the premiums on the cash secured put and the cover call. At the same time, you get the capital gains on the stock, right? The intrinsic value from here to here. So this way, this stock may be stuck, but guess what? You have this stock to make some income. This stock makes some income as well. So this is how you want to protect yourself in the event where the market crashes. Now, of course, the downside to that is that if the moment you enter the first one, if the market suddenly rallies, then you may not have a chance to enter this 2, 3, 4 other stocks, right? So you would just have one position making money, which is not as much as compared to if you have 4 positions on, but there's always a trade-off. So you want to think when the market, which is more painful for you, missing out on profits or getting into all 4 positions and then being caught and not being able to sell an income, right? So this is something that only you can answer. By the way, if this video has been helpful to you so far, I'd appreciate if you give me a thumbs up and also subscribe to my channel as well. Okay, back to the video. Right, so what if you have a smaller account? If you have a smaller account, then your choices are even more limited. So maybe you want to go for 3 stocks instead, right? Allocate roughly $3,300 each. So maybe you have technology, healthcare, and consumer. So as you can see, the smaller your account size, the more limited you are in terms of stock selection and the stock price as well. And generally, from what I notice is that the smaller price stocks, the lower price stocks, tend to be stocks that aren't as good fundamentals as the higher price stocks, unless they really had a stock split, right? Because generally, if you think about it, the stocks that have been around since 2000 and have survived all the crashes, the prices would have only have gone up, right? That means people have bought more into it. That's why the prices are slightly more expensive. So if you have a smaller account, your choices are more limited, so you have to be much more selective, right? Now, next would be vertical diversification. So vertical diversification is, instead of going for many stocks, you just choose one core stock or ETF with multiple entry levels, right? So I would generally always prefer ETFs as well, because it, like I said, it is diversified in a sense already compared to one stock. So let's say, for example, you have $20,000 account. So there are two ways you can stagger the different levels. You can stagger them by either dollar or percentage. So dollar is basically just, let's say for example you have $20,000, you just go by different levels, right? Let's say you split them into 5 levels. The first entry levels will be at $50, the next level 45, 40, 35, 30. So this in total will be $20,000. So in this case, actually, you're not really that afraid of a crash, because if the market really crashes through your levels, that is how you actually make money, because the more levels that you get filled, or rather you get assigned on the 100 shares, the more you'll be able to make, because you'll be able to sell, your cover calls and your cash account put at all times, right? So if the market was to just go back and forth like this all the time, guess what? You'll be able to sell your cover calls, you sell your cash account put all the time, right? So this is by dollar interval. Now, what about percentage interval? The other way is by percentage. So basically for percentage, I like to just identify the percentage based on the high of the stock's price. So let's say, for example, the high is $70, the current price is $50. Then I might say, all right, my first entry level for the cash account put will be at $45.50, which is 65% of the stock, right? From the highs, right? So that means the market has really dropped 35%. And at this point, right, I may want to plan a drop of all the way to 45%. I may think that maybe 45% would be one of the lowest point where the stock could go to. So this way, I would have 5% interval each. As you can see, it's 5% interval difference from each level. So this way, I plan the percentage and then the cash account put levels respectively. So of course, we do not enter all at the same time. We want to do this each time depending on where the stock moves, right? So for example, at the moment right now, if the stock's $50, I'll only sell the cash account put for $45. Now, if the stock goes past this first cash account put level, then I will start to sell this $42, right? If it goes further down to this zone between level 2 and level 3, then I will sell this $38.50, and it drops further, I will sell this, and so on and so forth. So basically you get it. So the whole idea of vertical diversification is that your mindset is much more towards preparing yourself for any worst case scenario, because you never know what's going to happen, right? If the stock has bad earnings or good earnings, and then the market interprets it as a negative thing for some reason, right, the market could just gap down. If you had only one entry, if the market was to gap down, you're going to be caught, right? Like I mentioned earlier. But if you have many levels, you're not going to be afraid of that, because you have already prepared yourself for a big drop, right? As you can see, from the first level to your last level, that is a 20% drop, right? A 20% drop is pretty big for a stock or even an ETF, right? So when you do it this way, you're always preparing yourself for getting an income. So if the market drops, you're selling cash account put, selling the cover call all the time, right? Now, of course, again, like I said, if the market was to just rally after it goes up, then you're going to miss out on selling level 2, 3, 4, 5. But right now, in the current situation, where we are in a bear market, the market is crashing, vertical diversification would be my choice in terms of doing the wheel strategy. So here is an example on the XLF. So XLF is the ETF, the financial ETF, which is actually a very low price stock, right? It's a very low price ETF, and it's very good if you have a small account. So let's say, for example, you have $20,000. Right now, you can see the market is roughly around $31.18. So you could plan this all the way to how far you want it to go. So I always want to plan for the worst case scenario, because I don't want to get, be in a situation whereby the market really crashes, then I go, damn it, I should have, waited a little bit longer before I sell the cash account put. Because the thing is that we never really know. We don't know how far the market can go down further. We don't know when it's going to snap back up. So all I know is that I just want to prepare for in case there is a possibility it goes down. And my aim is to always get an income. So this is the pandemic low, right? 2020, there was the crash. So to me, I may think that, all right, this might be a possible low that the market may reach if it continues to go down, continues to crash. So I want to prepare for this event. So I want to prepare levels all the way down to this level. So in this case, I'm at $2 difference in between the levels. So you can see I can prepare starting from $30 and then have $2 interval. Every $2 interval, I will have a cash secured put ready to get activated. And then the lowest price will be $16, which is just below the low of the pandemic. And then the lowest I could get actually two cash secured put, because if you were to add all this up, the total capital would be around 20,000, would be just about $20,000. So you know that you have everything laid out, all planned out. So as we know, as the market goes low, there's always a chance for it to snap back up. So as you can see, I will be selling cash secured put on each of these levels, and let's say it does snap back from here. Guess what? I'm able to earn the intrinsic value gains, the capital gains, if I get assigned on the 100 shares for each of these levels, right, as it goes up. So this way, I always ensure, right, I prepare myself that I'm always getting some sort of income regardless of where the market goes, right? So I know that I'm already prepared. So this way, all I do is I just execute it if the market goes up. Now, what happens, all right, what happens if the market just goes up from here, right? Let's say you sold the $30 cash secured put and the market shoots up, right? The market shoots up, let's say, to $36. What do we do now? Well, you can recalibrate your whole cash secured put levels, right? So maybe if it goes up, wait for it to come down, then maybe at this point you could say the new level will start at $32. Then again, you want to start to reevaluate the dollar interval. Maybe then you might want to do $3 interval if you still feel that maybe you say $16 is going to be the low I want to have. So you take $32 as your first entry and $16 as your last entry. Then you want to calculate your capital to see how many dollar intervals you have, right? Maybe it's a $3 interval to eventually match the lowest at $16 or thereabout. And then basically this is how you do it, right, for the vertical diversification. Now, if you have a $10,000 account, it's going to be a little bit more difficult to get more levels, as you can see. So you might only be able to do 4 levels for $10,000, but you still be able to plan yourself, to the lowest level, $18, right? So this is just one alternative, right? Maybe you're more optimistic. If you're more optimistic, you might say that, hey, I think $26 could be, a very good price to get in. That will be the lowest. So you may not even want these 2 levels. So in this case, it means that you still have more funds to do additional 2 levels, right? You may want to put 2 more levels in between here, right? So you have total 4 levels, and maybe this will be just nice, $10,000. Use up the $10,000 capital in your account. So basically, you can see it's very versatile in how you can arrange the levels for the wheel strategy. All right, guys, so some takeaways. So with small accounts, you have a very limited choice of stocks to choose from. That's why you want to be very selective with the stocks you choose, and that is why diversification is very important to avoid getting caught in a position when the market tanks and you have no more funds to continue the wheel strategy. So this is a very common problem right now. A lot of people have actually mentioned that they are caught in their position where their cash secured put is very deep in the money. What can they do? Well, in that case, there's pretty much not much you can do, rather than, all you can do is just get yourself assigned, get 100 shares, and just hope that the market goes back up if you're out of funds. But if you still have the funds, then this is where you want to start to prepare, right? So there are 2 diversification methods. You have horizontal diversification, which is 3 to 5 stock or ETFs with 1 position each, and then you have vertical diversification, is 1 core stock ETF with multiple entry levels, and then you have the diversification for vertical in terms of dollar intervals, and you have percentage intervals. So the most important thing is to always plan for the worst case scenario to ensure you always have funds to generate an income for the wheel strategy. So remember, wheel strategy is an income generating strategy that you are always selling something, selling a cash secured put or a cover call, so that you're always getting income. So the key for it to be successful in the long term is for you to plan the worst case scenario and to diversify according to either the horizontal method or the vertical method. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.